Now, we are starting to see the 50-day flatten out. We're starting to see the 20-day moving average turn down. That's not a great sign. That doesn't, we've seen these wiggles before, and then they correct themselves, market takes off running again, everything's fine. But if we begin to see this kind of price action begin to flatten out or deteriorate, I'm going to become a little bit more concerned about the amount of exposure we have in our portfolio and begin to kind of start looking to reduce. But again, I'm not going to do that here because markets are decently oversold. I'm going to look to reduce exposure on a bounce and rebalance.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back at the end of another week for another weekly market recap with my good friend, the tryptophanic portfolio manager, Lance Roberts. Lance, how you doing?
Not yet. Not yet, because I'm not a big turkey eater to start with. So for Thanksgiving, I have brisket, sausage, chickens, all barbecued, right? I'm in Texas, right? So we're doing a traditional Texas Thanksgiving, which is brisket, sausage, ribs, and chicken. So
No armadillo?
tryptophan is only for you people that live out west that eat turkeys.
That's not true. I grew up in New England. We had a lot of turkey on
I
Thanksgiving.
thought y'all had lobster up in New England.
Well, hey, we started the turkey Thanksgiving, right? Back in Plymouth Rock, man.
This is true. This is true.
Well, anyways, first off, happy Thanksgiving in
You too.
advance, Lance.
Yep.
Happy Thanksgiving to all the viewers too. It's funny because as we hopped on, you mentioned being sleepy, and I said, well, wait till you hear the word of the day. So,
It makes complete sense now. Yeah.
yeah, yeah. I'm going to believe that whether there's tryptophan or not in brisket, that you're still slipping into a big food coma after you eat all that.
Oh yeah, of course, of course. That's just tradition. Eat a big lunch and then take a nap on the couch. Absolutely.
All right. Well, there's a lot of people that are feeling, I think, not sleepy right now. I think they've actually had a sleepless night last night. We're recording this Friday morning. Markets are still open today, as they usually are, as we record on Fridays. But the day before, Thursday, seemed to be a very material day in the markets, Lance. Big reversal.
Mhm.
I think one of the bigger reversals we've seen in the market all year on a intraday basis. And what was notable about it was the market had been weak, as we've been tracking over the past couple of weeks.
Yep.
Um, some doubts and concerns are starting to creep in about the AI trade. So the world was waiting for bated breath for Nvidia's earning release to see if Nvidia could kind of respark this market back into rally mode. And Nvidia delivered what the doctor ordered. I mean, it delivered great performance. It delivered just stellar guidance. The stock popped, I think, 5% or so in the aftermarket the night afterwards. As the markets opened on Thursday, Nvidia was up, I think, almost 6%. The indices were up in the green. And then all of a sudden, it all reversed. And
Mhm.
Nvidia ended up closing the day down, I think, a little bit over 3%. Another really big sort of risk on asset speculation, measure of speculation in the market, Bitcoin, just continued to get clobbered throughout the whole day. So there's a strong question hanging in the air right now, which is, has the market now really shifted from the risk on mode it's been in since May into risk off? Probably still a little too early to tell for sure, though I'd love to hear your thoughts. But right now, Wall Street is sort of sitting on the edge of a pin, watching the market really closely, trying to figure out where things are going to go from here. So, with that context, Lance, enlighten us. What the heck just happened?
Nothing. I mean, look, the markets have had a huge run since April, and you know, they got very far ahead of themselves. I mean, Nvidia is up over $100 a share since those November lows. So, again, a pullback in the markets is not surprising, and this is why we talk a lot about risk management. When markets really overbought, they're extended, take profits, reduce your risk, rebalance your portfolio, don't speculate, don't use leverage because again, you're going to get these corrections from time to time. And the reversal yesterday was really a lot related to today, which is the largest November options expiration on record. So there was just a lot of unwinding of contracts yesterday. People that were short tech going into yesterday's earnings reports had to cover that yesterday. So you're just getting a lot of that action. So just a big pickup in volatility. But again, we're getting ready to move into the end of the year. So again, really the tailwind for the markets are still very much in play. You've got buybacks at 5 to 6 billion dollars a day. You've got a lot of professional managers that are underweight equities that are underperforming for the year. So there's going to be big pressure for them to start buying into the markets here. And again, just from a technical basis, right? All we've done is had a bit of a pullback. And again, this is why, we always talk about, risk taking. And you'll remember a few weeks ago, we were talking about the risk when all assets correlate to one. Gold was surging. I think I said here on the show is like it's going to be a great short setup here shortly. Bitcoin was surging, stocks were surging, everything was going up at one time. And whenever you have those correlations do that, that's not, people try to apply narratives and say, well, this asset's doing this because of this reason, and this asset's doing it because of that reason. That's just rationalization to try to justify why all the prices are rising together. But when that occurs, that's the perfect setup for the market to have a correction. And again, the market's down, the S&P's down 3.5% from the peak. I mean, we're not even in a normal 5% correction yet. So there's still more downside to go. Now, if you were invested in levered assets like Bitcoin and some and levered ETFs, you've taken a pretty tough beating over the last 2 weeks in particular. But this is a very normal correction. I wouldn't be stressing out making any major changes to your portfolio. This isn't that type of environment right now.
Okay, so that's good to hear the calming sense of, hey, folks, world's not on fire. Um, let me ask you this, and we're going to get to the TA in just a second. You can walk us through. Um, Obviously, too early to answer this question, but I think one of the concerns that's being raised right now, especially given yesterday's market activity, is a number of the people that I have interviewed on this channel who have been skeptical of the sustainability of what they see as a bubble, a price asset bubble in AI stocks, is they've said what you want to watch for is the moment where Nvidia, the darling stock of this sector, delivers yet again just better than fantastic results, and yet it's not enough to power the party higher. And that's, you can say that's what we saw yesterday. Now, is that the definitive top of all this? Who knows? We're going to need time to find that out. But I think that's the big concern that people are questioning right now. So, Lance, what would you need to see here to say, hey, I think this is actually maybe potentially starting to morph into something more significant than just a garden variety pullback?
Well, you're going to see, are we talking about just Nvidia? Or are we talking about the whole AI market or the
No, I
whole
think this is the
general?
whole AI market, right?
Okay. Well, what you're going to see is a breakdown of technical supports across the board, a reversal from the bullish trend to a negative bearish trend. But again, we've seen this before. And again, you'll remember you interviewed some guy, probably 2 years ago that was talking about shorting, buying shorts in Nvidia and other types of things. And that was a horrible idea. And, Nvidia has rallied very sharply since then. And, the problem is, as we go through these periods, you'll remember August of 2020, June through August of 2024, the markets were down 10%. What was the reason? AI trades over. This is the bubble's unsustainable. This is the end of it all. And markets were down 10%. And then in October, that was the bottom. And then the market took off running again. April saw the same thing. So we keep seeing every time the market goes through a correction, immediately people that are looking to make a headline for themselves run out and say, "Oh, this is the top. You better get out of everything." We're way early. And even Nvidia talked about this yesterday. We're way early in this whole AI development thing. It's way too early to be calling this a bubble or a top or anything else. We're just getting started on this. And this is not a race. You and I talked about this last week. This is not a race we can choose to lose. So, the amount of money that's going to be spent on these in these markets that are going to benefit these companies is only getting started. It's not ending. So, if you're really worrying about the top of the AI, you know, that's fine. And we're going, and look, we're going to have some pretty significant corrections, 10, 20, 30% corrections in some of these stocks is not going to be surprising. I mean, look, there's going to be some companies, and I'm not saying that all companies are going to do well. Companies like Oklo and CoreWeave and others, they're under a tremendous amount of pressure. These may just be short-term corrections, but those stocks are down 20, 30% from their peaks. They may very well find a bottom and then have a renewed sense of buying if they can really start to establish their place into the markets. But again, this is why you have to be selective in any type of environment about the companies that you own. And so just being aware of that, buying. We talked about this last week. Buying fundamentals and those type of things are very important. And that's why in our core equity models, that's what we focus on. We focus on fundamentals, growth, free cash flow, those type of things. Now we do have the thematic models, which have all kinds of risk to them. And if you want to gamble roll the dice and take on a bunch of risk, we got a portfolio for you, right? But those are all based on companies that should do very well over the long term. It doesn't mean that every one of those companies will survive, but they're positioned in the right place to participate in the development of the market as it continues to go forward.
All right. Hey, and speaking of those thematic portfolios, while you were out last week, Mike Leibowitz mentioned that you guys did indeed launch the oil and gas
We did.
portfolio. We didn't get a chance to talk about that in depth, so maybe we can reserve some time today, Lance, to
Sure.
have you walk us through it, if that's okay.
Yeah, yeah,
Um,
that's fine.
all right. So I want to just clarify something you said to make sure I understand it. And look, you know, I've a lot of people I've interviewed, lately have said, hey, sure, I got lots of concerns about, whether the AI sector is in a bubble or not, but I'm not yet willing to stand in front of that train,
Yeah,
right? Just had Mike
exactly.
Green on, who basically just, sort of sighed with resignation and said, look, I think this, giant mindless robot is just going to keep winning the day
Yep.
until at such time it doesn't, but I'm not seeing any signs that it's starting to crack. So, I very much get the like, hey, look, this thing could still have a lot longer to run. Um, but I think there are equally valid concerns that about valuations and we'll talk in just a moment, about the integrity of the spending that's going on in this space right now.
Sure.
So I don't disagree with the comment
No,
you
no,
just
no.
made
Yeah.
of hey, the spending in this space over the next decade is highly likely to be tremendous because even if the companies aren't able to do it themselves, the government is likely to step in because, as we talked about, this is a kind of an existential priority that the U.S. sees it needs to win on the world stage.
This
Um,
is a national. This is so the government has two jobs and only two jobs in the world we talked about before: national security and infrastructure, and this is both of them.
right, but
So
I just want to clarify that does not necessarily equal tons of profits for these companies.
no,
It is probably correlated with it, and there are times like now where these companies are going to be getting fat at the trough. But it doesn't mean that, oh, well, then stock valuations for this sector is guaranteed to be a straight elevator ride higher, forever, right?
right. And
And
this
you're
is
nodding
this is
as
what
I'm
I'm
saying this.
saying. This is what I'm saying. You have to be very, very selective about companies that you're buying long term. And again, so we're talking about two different things here. So one, if you're speculating in the AI trade, that's a very different thing. If you're trading short-term stocks, that's awesome. Like those thematic models, they're fairly short-term in nature. If you're buying long-term, like our core equity models are long-term investment models, right? So we're looking for companies that are going to be here 10 years from now, 20 years from now, 100 years from now, and they're going to participate on that. So, there's going to be, companies like Nvidia, they're in a very good position because you build out a data center as an example and you put in all the new Blackwell chips. Well, eventually there's going to be a better chip that comes along and Nvidia produces it and they're going to have to replace all those chips. So there's a consistent revenue source for Nvidia on that side of the data center. If I'm just building the data center building and I'm charging rent for it, once it's filled up, it's filled up. My rent stabilizes except for inflation, right?
Right.
So
Well, and there's 1,000 companies that can compete in that space too.
exactly. And then there's going to be a lot of companies that provide AI software, right? And so, I'm a company that provides AI agents for, agentic, kind of uses. But then somebody else comes along with better AI agents, and then my business is out of business because nobody uses them anymore. So, there's going to be company, and again, we saw this in the dot-com era. There are going to be companies that survive. And there are going to be companies that profit enormously from what's going to happen with AI. There's going to be a lot of companies that go away. The core weaves, the applieds, a lot of these other ones, maybe maybe they survive, maybe they're the winners, maybe they're not. There's other openings in there for those companies to get displaced by somebody else that can do the job better, cheaper, faster, whatever, or just differently than what they do, and that's where everybody tends to go.
Yeah, and so look, there's a couple of types of risks here, and the one I started asking about, I just want to put a bow on here because I know it's
Sure.
important for a lot of viewers here, which is it's more the overvaluation, the potential overvaluation risk here. And the reason why they care about it is they don't necessarily care about Nvidia specifically as a company, but they care about Nvidia's supreme importance right now in
Mhm.
terms of driving the indices in the general market. And so there's a fear that like, hey, if these things are overpriced and they go through a 30% price correction just because, right, the world just wakes up and says, hey, you know what, we pulled too much of tomorrow's value into today.
Yep.
I'm worried I'm going to be collateral damage to that, even if I don't own Nvidia,
Mhm.
because the S&P is going to tank. All these other ETFs that because of the giant mindless robot, have huge positions in these things, even though I wouldn't necessarily think
Mhm.
whatever general ETF is loaded up on Mag 7, but they just are because they're such a huge part of the market. I think that's the fear that most folks have. But anyways, what I hear from you saying is
By the way,
valid
though,
concern, but not time to panic on it because you're not seeing technical signs that
right.
that's risks is in play.
Yeah, no, no, and that's exactly the point. Yes, you're going to have 20-30% corrections in this market, right? As we go through whatever this is going forward. It doesn't mean it's happening now. It doesn't mean it's going to happen tomorrow. I mean, it could be next year. I have a lot of concerns about next year. There's a lot of displacement between earnings expectation and economic growth next year that I can't quite wrap my head around, how you're going to justify that. So at some point, there's going to have to be some type of reassessment of those type of issues as we move into next year. But again, this is what separates out the individual, which tends to vastly underperform over time versus, a well-structured, disciplined investor that tends to succeed is that you have to understand that those are things are going to happen. This is why we talk about managing risk, taking profits, rebalancing those things that we do so often. And I get a lot of emails like, you're rebalancing here, the market's just going up. Yeah, I do that all the time. We're getting ready to go into the end of the year. We'll do tax loss harvesting. We'll do rebalancing going into the year to, be more tax efficient with portfolios, things that you should absolutely look at doing in your own portfolio. But again, when the technical market starts to break, this is why we focus on technicals, is that eventually we're going to start getting technical signals that say this market is about to go through the process. And this is why we got out of the markets in 1999, early 2000s, when we got out of the markets in 2007. It's why we got out of the market in February of 2020, why we got out of the market in February. Not and when I say get out of the market, I'm not talking about we went to 100% cash. We
Yep.
reduced a lot of our exposure. Same thing in February, March of this year, we were lightening up on positions because those technical indicators were starting to tell us, hey, we're getting set up here for a bigger correction. We don't really have that just yet. We have there's some short-term concerns here. This could be a 3 or 5% correction. We might get a little bit of a bounce, and then I would expect another correction in the first 2 weeks of December as mutual funds distribute all their incomes and capital gains for the year, and then you'll be set up for kind of a year-end rally. So, again, that whole thesis still kind of plays out, and we're about to go into, holiday Thanksgiving week next week, which is where the inmates run the asylum. All the traders are after today's OPEX, all the traders are leaving for the Hamptons, so they're gone.
Mhm.
So next week it's just all the retail traders running around, buying stuff, and so we'll see what they do. But again, it's just, we're just going through a bit of a consolidation, a correction phase here after a very, very, and again, people forget just, and again, you and I have talked about this before. When markets are going up, everybody's smarter than they think they are, right? Because market like I can't go wrong. I just throw money at the market and I just make money. It's
It's
great.
it's the other way around. They're not as smart as they think they are. Yeah, but yes.
Yeah. Yeah. Well, that's what the market proves to you pretty quick. And remember, everybody was chasing gold. They were chasing Bitcoin. It didn't matter what you bought. It was just going up. And, those are the things you worry about. You don't worry about these corrections. This is an opportunity to put some capital to work if you were smart enough to take some profits previously and have some cash sitting on hand to put to work here.
So a couple of things. So first off, I'm glad you just clarified there that Um, you cited those periods of time in
Yeah.
recent past where you guys reduced your exposure to equities because you were seeing technical signs that things could be degrading here. Sounds like you're not at that stage yet. You're not doing that
No,
right now.
not
Okay,
yet.
no, you're shaking your head. Okay, that's really good to know. To your point there about yeah, some people being smarter than they think they are. There's a guy, I'm not going to mention his name, but there's a guy who, I don't know, a couple months ago, I started noticing was just like totally slamming me on X. And I had no clue who this guy
Oh, not
was.
me.
It wasn't, yeah, surprisingly, it wasn't you. But a guy who had
I
his
never
own,
slam you on X. That's
yeah,
that. I don't do that.
you just slammed me live on YouTube. No, I appreciate that.
Exactly.
Yeah, you like to look me in the
It's
eye when you
only
stick the
because I
dagger
love
in.
you like a brother. So
Yeah.
we have a brother relationship. So yeah, I pick on you a lot. I'm older, so I'm the older brother. I get to pick on you.
Yeah, well, I was the younger brother growing up, so I'm very used to that role. But anyways, this guy, it was basically just saying, oh, Taggart's one of those doomer perma bears, and he, never had anybody in his channel who had anything positive to say, and all this stuff. Whatever, the guy's entitled to his opinion, but he just kept coming after me, and a lot of people who were following him were starting to tweet me and say like, I don't know what's going on with this guy, but I don't know why he's going off like this. And I went to his Twitter feed and noticed that I wasn't the only one getting his ire, and he was going after a bunch of other guys. And to me, it seemed pretty clear that this guy was trying to punch up, like, trying to trash people who had bigger followings on X in order to hopefully kind of, gain notoriety and build his own following. So whatever, I just put him on mute and didn't really think twice about him. Um, I had some people send me some of his tweets yesterday because the whole time he kept saying, everybody should be watching me because I've been crushing the market and I know more than Goldman Sachs and Morgan Stanley, and I've just had this fantastic thing. And then yesterday was sort of a mea culpa post on him of like, oh gosh, I didn't see this coming. I really got zorched, yesterday and all that stuff. So it seemed like a great example of what you were just talking about, Lance, is these
Yeah.
people just get on a high. They're riding a tailwind that they think is, they begin to interpret is because of their own genius, where they're just really riding this force of nature. And as soon as that force of nature zigs when they thought it was going to zag, they're left for
Yeah.
gravity to take over.
No, and look, you're like, as we were talking about earlier, it's like you said you don't see any signs of the market breaking down, right now. And no, I don't. There's not, we don't have big volume spikes. We don't have a lot of things, credit spreads aren't blowing out, those type of things. So, but that doesn't mean it couldn't change tomorrow. I mean, next week we could get on the show. It's like, hey, we just cut 15% of our equity exposure this week because A, B, and C happened.
Happened, right?
We're never, just to be clear, we are never going to buy the bottom and we're never going to sell the exact top. We may get lucky, right? But generally we're early getting out and we're late getting in. And that's just, but that's how we navigate markets over time. And, I try to realize that I'm not smarter than the markets and I'm just trying to follow along with what the markets are telling me. But this is, but again, this is the risk. And again, to your point about, the kind of the tweet exchange you were having, I get a lot of that too. People
But
take,
by the way, I wasn't exchanging tweets with this
I
guy. This is
understand.
all one-sided. Yeah.
Yeah, I know it. It's always that way with me too. I never respond
Yeah.
either. But I get, people will take something out of context that, I was on Adam and I said, hey, yeah, the markets are gonna rally until the end of the year. So it's no worries. That's not what I said. What I said was is like we could have some some corrections along the way, but the bias to the end of the year is higher because of earnings, because of buybacks, because of these other things. The seasonality of where we are over the next 2 months. It doesn't mean it's going to be a smooth ride higher. There's going to be some bumps and corrections, and we're in one of those right now. So it's always important to keep things kind of in context of what's going on and just understand that this is why we do rely on technicals to try to give us some idea because let's back up. I did a whole segment this week on the Real Investment Show talking about technical analysis on Tuesday's show. Actually, it was our Two Deads on Money episode. We did a whole thing on technical analysis. So if you're interested in getting a complete explanation of how we do technicals, just go look up our Two Deads on Money this week. But we were going through that and explaining that this is technical analysis is a picture into what the whole market is thinking right now, right? This is buyers and sellers in the marketplace, and they both think, the buyers think they're right, the sellers think they're right, and they're all meeting their minds at a certain price in the markets. And that's what's going on. That's why technicals are so good for you to understand, at least have at least a modicum of understanding of technical analysis if you're investing your own money, because it's telling you what the market's saying. You can have your own narrative all day long, right? Dollar debasement, or the world's going to end, or the AI bubble's going to blow up, or vice versa, right? AI is going to go to the moon and there's no stopping it. Um, that narrative is fine, but is the market agreeing with you? Right. And that's why we always go back to the technicals and say, what's the market saying? It doesn't matter
Right.
what my opinion here is with you. I can spout stuff all day long with you. It doesn't matter. What's the market saying? And so that's why when we get down to portfolio management and we talk about that, it's always back to, managing risk, managing exposure, those type of things, because we're paying attention to what the market's telling us that it's doing. And whether or not we agree with it is irrelevant. It's what the market's doing that's important.
Right. You're right. When we say, look, you trade the market you have, not
Mhm.
the market you wish you had,
Yeah,
technical analysis is what tells you, that sort of defines the market that you have. Right. So
that's right. That's right.
totally get it. All right. So speaking of technicals, Lance, can you
Mhm.
pull up the TA here?
Sure.
Let's take a look at where we are in terms of the moving averages, the Bollinger Bands, and all that stuff. Um, and yeah, well, let's start here with the S&P and
Yeah.
see where we go from there.
So a couple of important things have happened here over the really over the last 2 weeks, and again, we've talked about two things you and I have talked about two things over the last several weeks that have been concerning, and one was this negative divergence in relative strength. So we've talked about the weak breadth of the markets. We've had a lot of stocks not really participating with the markets. It was fairly narrow. That's never a good sign. And you had this negative divergence. Relative strength was declining in the markets, even though the market was still rising in price. That always tends to occur before you get a correction in the markets. Now, when we've had this before, we saw this very same type of negative divergence back over here. And this was one of the reasons back in February and March that we were reducing exposure before the market broke down, was because we had that same type of negative divergence. And then finally the market gave way in April because of the whole tariff issue. We don't have the tariff issue right now hanging over the head. There's no big kind of catalyst to drive a major downturn. So that's why we're not as concerned as we were then. But it's still important to pay attention to. Now, the markets had this really big run right here in late October, going into early November. So the markets got really overbought on a short-term basis, pushed up in overbought territory, but you just had this really big sharp advance kind of out of nowhere, and markets got very deviated above their means. And this is what we started talking about a few weeks ago. You and I were saying, hey, markets are very deviated here, take some profits, kind of rebalance risk, those type of things, because we're probably going to get some type of consolidation or a pullback. And that's what's happened here. And so we're currently sitting on the important thing is we broke through the 50-day moving average. That's this blue line. So we were above the 50-day moving average for, don't quote me on the number, but I think it was 139 days. It was like one of the longest stretches above the 50-day moving average we've had in quite some time.
Yeah, I mean, pretty much since the end of April, it looks like.
Yeah, yeah. But I mean, I'm talking about the length of the
No,
stretch.
no, I know. Yeah.
Yeah, it was just a very long run. And there's nothing wrong with that, because all a moving average is it just tells you what the average price was over the last 50 days. But what is unusual is that when it stays above that 50-day moving average for a very extended period of time, because an average means the price of the market was both above and below that average over the last 50 days. And that's why we like moving averages a lot, because they really kind of tell you where support is. And they kind of tell you what the trend of the market is. And so the good news is that up to this point, the 50-day moving average is rising, the 100 days rising, the 200-day rising. So we're seeing over the last kind of long period of time, prices have been trending higher. That's good. But moving averages act like gravity, and you're eventually going to have that gravitational pull is going to pull prices back to that average or below it. And that's when we talk about mean reverting events. What's a mean reversion? A mean is the average, and reversion is basically prices are reverting back to that average. That either means from above it to it, or below it, or from below it back above it. So that's the reversion. You have mean reversions in both directions. So right now we're having a negative mean reversion. Stock prices have come down. Now, the good news is today we're decently oversold. We're not extremely oversold, but we're decently oversold enough here for a bounce. and markets are bouncing off the 100-day moving average. Now, this is of what time is it right now? It's 10, so it's 10:35 Houston time on Friday. So we're just 2 hours into the markets. Um, so this could, and again, today's OPEX day. It's the largest November OPEX on record. How this day ends, I have no idea. It could be positive, negative, whatever by the end of the day. But right now, we're trying to hold on to that 100-day moving average. So that's some okay news for right now. That could give us a bounce in theory. We could see this market bounce from this condition back up to around, say, 6,200, which is or sorry, 6,700, which is where the 50-day moving average is. So that's a decent little bounce here. If you get that bounce and you've been under a lot of pressure in the markets, I would sell some stuff on that bounce. I wouldn't expect an immediate retracement back to all-time highs. So if this decline has really weighed on you, so for instance, this is about a 3.5% decline from the peak. Our portfolio is down about 1.5. So I don't have a lot of pressure right now to do anything because our portfolios are holding up very well. But if your portfolio is down 7, 8, 9% from the peak, then you've got too much risk in your portfolio. So I would use that bounce back up towards 6,700 to maybe reduce some risk, rebalance some exposure. Now, we are starting to see the 50-day flatten out. We're starting to see the 20-day moving average turn down. That's not a great sign. That doesn't, we've seen these wiggles before, and then they correct themselves, market takes off running again, everything's fine. But if we begin to see this kind of price action begin to flatten out or deteriorate, I'm going to become a little bit more concerned about the amount of exposure we have in our portfolio and begin to kind of start looking to reduce. But again, I'm not going to do that here because markets are decently oversold. I'm going to look to reduce exposure on a bounce and rebalance.
Okay,
That makes
so
sense.
let me ask this
Sure.
question. When you were talking about mean reverting and
Mhm.
these things act like gravity, which you've mentioned many, many times before,
Yep.
is a good way to think of moving averages is they tell you where the puck is headed. They just don't tell you when it's going to head there.
Um, they tell you to, yeah, that
Because mathematically, you have to get back to the mean, right, at some point, right?
yeah, it's the timing issue. Yeah, the
Right.
answer to your question is yes. What moving averages tell you, and again, it's when you're in extremes is it's even more important. So again, this right here, this spike where you spiked well above this gap between the 50-day moving average and where the price is, that's deviation, right? You're deviated from that 50-day moving average. So think about it like a rubber band. If I stretch a rubber band as far as I can in one direction, eventually I've got to relax the rubber band before I can stretch it again. And that's
Yep.
that's what prices tell you. So the to your point, when I get really deviated above that moving average, your odds are much higher. You're going to get a reversion fairly soon back to that moving average because gravitational force increases. And if you get very far below it, kind of like you are now, we've got a decent deviation below the 50-day. Now that rubber band wants to snap back in the other direction. So yes, what it doesn't tell you though is timing. It doesn't, we've seen periods where markets can stay above the 50-day moving average, as we just saw, stayed above the 50-day moving average for a very long period before eventually breaking it. So the timing is always a difficult
Mhm.
issue.
Does that make you worried when you see a long stretch like that, where you're like, oh, that means we're going to have a prolonged period of time under that average just to continue to make it the average?
Well, no, it's not. It's not time. It's price. So what I'm saying is let's say that I'm above the 50-day moving average for 100 days.
Yeah.
That doesn't mean I have to be below the 50-day moving average for 100 days for it to balance out because markets are going to rise over time. So generally, breaks below moving averages are generally fairly short-term events. They don't last for a very long time. A good example is back here in April, right? We had this very sharp sell-off, cracked through all the moving averages, and then a month and a half later, it's over.
Yeah. But
That's that's fairly
sorry,
normal.
let me just ask this again.
Sure.
I'm trying to think of this like almost like a calculus graph. It's the volume, right? In other words, you could be over the moving average by 100 for 100 days, but let's say you're only 10% over it. Does that
Mhm.
mean that you need to make up for that volume when it corrects? And that could either be 100 days at 10% below, or it could be 10 days, but you're at 50% below, right? It's a big correction in the short term, but you're equating the same volume below that you were above. Is that the way to think
If
about it?
no, it's not, because if you think about it that way, right, your market would trade in a flat horizontal line.
Well, to your point, the moving averages move themselves. I get that. Yeah.
Yeah, and so if it was spending the same amount of time above and below the line, the 50-day would essentially be flat. So since, and and look at this chart. This is a good example, right? So you can see that when markets get really deviated above the 50-day moving average, you get corrections below it, but they're fairly short-term events. They're quick. And that's because the average is rising over time. Now, here you saw April, and this is a good example, right? So in April, we saw this breakdown of the market. Moving averages turned negative, and we spent more time below the 50-day moving average than we did previously because now we're trending below that moving average. So now we're pulling the average 50-day price down.
Yep.
So we're going to spend more time below that. But as soon as we can reverse that, then we're going back in the other direction. So it's typically, historically speaking, the time you spend below a moving average is often much less than you spend above it. But again, now if you go back to say like the financial crisis, we had a very, very deep breakdown below those moving averages, and that period took, almost a year, right? So before we actually resolved all that issue. But you also had a financial event going along with it. So when you don't have really type any type of big, economic credit related, financial event going on, breaks below these moving averages are typically better buying opportunities than they are selling opportunities.
Okay. Okay. Totally get it. All right. And we're going to talk about private credit in just a little bit. Do me a favor, just bring this chart back to where it was from sort of the start of the year. Yeah. Okay. Nope. Nope. Go back just a little bit more. I want to capture what happened in April. So, uh, as you are saying right now,
Mhm.
this is looking like a relatively, standard pullback. It's not that bad. In fact, I won't pull it up here. Well, maybe I'll pull it up in a minute. I know you guys have your own greed and fear index,
Yep.
but just looking at the standard one that CNN publishes, it goes from 0 to 100. It's currently at 6. I think it was at 20 something last week with Michael, but basically they're acting like the world is ending, even though it's what you said, about a 3% correction so far
Right.
since the highs, right? So
Exactly.
everybody just keep everything in perspective for the time being. And this could, we could find support here, and the stocks could bounce from here. Time will tell. We'll track this on a weekly basis. And to your point, Lance, about saying how your stance at RIA
Mhm.
can change on a dime if the market situation changes on a dime. That's why we have you here every week. So folks, that's just have the confidence that we're gonna have Lance or his partner Michael here holding our hands and telling us what they're seeing in real time every week. But I just want to show. Sorry, go back to where it was because
Yeah,
it's
I
now.
know where you're going, and I want to front run you a little bit because of what we're seeing right now. This pullback is very similar to pullbacks that we saw in all of 24 and really, or 2023 and 2024. So similar declines to the 100-day moving average. Markets found support, rallied off. And there were lots of concerns in here. This decline right here, this is that 10% fall in the market in the summer of 24. AI's dead, Nvidia's over, blah, 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 right? And then the markets took off running again. Same thing over here. This was Chat GPT and, the end of the world because of, sorry, not DeepSeek,
Deep
right?
sea.
Because of
Yeah.
DeepSeek sell-off. DeepSeek's going to, OpenAI is dead because of DeepSeek, and then markets took off again. So the current sell-off is very akin to what we're seeing previously. Doesn't mean it can't become, to your point, it doesn't mean it can't become this. It certainly can. I do not want to discount the risk that this could, we could break down here, crack through the 100-day, run down to the 200-day, which would, by the way, talking about deviations from long-term means, we're extremely deviated still from the long-term 200-day moving average. So a correction of 200-day, not out of the question at all. And I think you need to be prepared for that. It won't go straight there. You're going to have bounces as you get down that to that level. But you need to be prepared that this correction could be deeper for a variety of reasons, but we don't really have a catalyst at the moment. Right now, the market's really just struggling with, is the Fed going to cut rates in December or not? That seems to be the real catalyst here. Kind of repositioning for maybe not getting a rate cut in December. but we don't really have like the whole tariff situation like we had back over here. That's been mostly resolved, it seems like. We funded the government through January, so we don't have the shutdown issue to deal with right now. So there doesn't seem to be, and again, something could crop up, but there doesn't really seem to be some type of kind of tail risk event that is starting to weigh on the markets here. This seems to be more very short-term positioning concerns more than an event concern.
Yeah, and what I get clearly from you is, hey, we're treating this like the previous pullbacks that we saw, where we expect things to, bounce and start reversing higher again, until and unless we see evidence otherwise. The thing I just wanted to mention, and you did largely predict where I was going, but if someone's looking at the RSI and saying, oh, okay, well, look, that's finally come down, it's now kind of plumbing near the bottom, that means this thing's ready to turn.
Be careful of
Quite
that.
possibly, right? But if you look back at what happened in April, we got down to the bottom, we had a little, tiny little bounce, and then it stayed down there, and the market, dropped another, what, 1,000 S&P points or something like that. So,
But great example. Glad you brought that up, right?
yeah,
So here was a similar. So let's just assume that we're here. Okay. So this is now. Let's just assume this is right now.
yeah,
So market was coming down, and again, negative divergence in RSI, like we've been talking about. Nice sell signal on the MACD, like we have right now. All those things are the same. Markets oversold. So markets are coming down, and I'm like, hey, don't worry about this right now. Markets are oversold now. Here we had already lightened up on positions because there was a lot of other stuff that was going on. But regardless of that, so markets are coming down. Say markets are decently oversold, should get a bounce here. Well, you did, but the difference here is that you broke the 200-day moving average, went below it, recovered back up to it, failed at the 200-day moving average. This failure at the 200-day moving average was critical because that told you now you have a trend change in the markets. And then also at that time, you also had moving averages were breaking down, crossing over. You had a lot of all the previously rising bullish moving averages are now turning negative. So now they're telling you that you have much more substantial risk to the markets. And again, another reason to start cutting exposure. And then you got very, very oversold. And this is where we started buying, back over here. But again, yes, just because we're currently oversold does not mean that we cannot get more oversold. You're likely going to get a bounce, but if we bounce to 6,700-ish, which is the 50-day fail there, and then come down and take out the 100-day, we got problems. And that's where we're going to be cutting it. If that happens, that's where we're going to cut a lot of exposure.
okay. And folks, again, if that happens, we'll be tracking it here with Lance and his team on a weekly
Sure.
basis. If you want greater frequency than that, follow Lance on his YouTube channel, follow me on Twitter. We'll be talking about this stuff in real time. But again, just underscore Lance's point, he's not seeing evidence yet that any kind of breakdown like that is in process. And so he's still, largely just as invested this week as he's been the past bunch of weeks.
Yeah, yeah.
All right.
Exactly.
So
And look,
go ahead.
just real quick, shameless plug here, but if you go to our website, realinvestmentadvice.com, and scroll down to where it says market commentary and research, we produce a daily market commentary, and I put a trading chart every day. I can just click the subscribe button, throw your email address in. Nobody's going to spam you. But every day I send out it's about a 1.5, 2 minute read. It's fairly short. We hit some major topic, but every day we have a market trading update. So we talk about, we just talked about Bitcoin yesterday. We'll talk about gold. We'll talk about whatever's trading in the markets, and we'll lay out technical levels, risk levels, those type of things as well.
All right. Hey, just because you just mentioned it. So
Mhm.
let's talk about Bitcoin for a second.
Sure.
So Bitcoin, has seemed to have been the canary in the coal mine for the weakness that we've seen in the market. It's been weak for a while, and it's continued to really weaken in recent days, and the chart there shows exactly that. Um, I've heard a lot of people saying, "Hey, this is maybe a sign of liquidity starting to get scarce, and Bitcoin is a kind of a hyper indicator of volatility." I've had other people say, "No, this is investors turning to risk off, and Bitcoin's been a risk on asset, and it's leading the way for where the rest of the market's going to follow."
Mhm.
You guys said you just talked about this at length yesterday. What were sort of the crib note takeaways from that?
Well, this is a lot. What we've seen, recently in a lot of assets is people piling into leverage. And what you're seeing, and we particularly see that people buying assets on leverage with things like Bitcoin, because that's where they can make the most money because it's such a volatile asset. The market goes up, 0.5% a day or 1% a day. Bitcoin can move 5 or 10% a day. So if I'm going to leverage an asset, I'm going to leverage something that can move a lot in a very short-term basis. So what you're seeing is kind of a
As
couple of
long as you're correct in hoping it goes up.
exactly. But there's actually two things that are going on here that, and this is what we actually talked about earlier this week, is that, the retail crowd was begging Wall Street to bring ETFs for Bitcoin to the marketplace. And this is why we always warn you about be careful what you ask for from Wall Street, because Wall Street will provide you whatever you want. If they can make money on it, they'll provide it to you. Well, what Wall Street was more than happy as soon as they could get it passed through the SEC, was more than happy to deliver ETFs to the markets. Why? Well, A, you're going to go throw your money into a Bitcoin ETF or an Ethereum ETF. That's great. They don't care about that, right? What Wall Street wants, they want the ETFs because they can short those ETFs. So all of a sudden, they have a really easy way to arbitrage their portfolios and take advantage of market downturns by shorting those ETFs. So you've got liquidity issues, one going up, but you've got Wall Street working against you, taking advantage. Everybody that piled those ETFs, Wall Street was like, bring it on because I'm going to short the crap out of those. And that's what they did because Wall Street's always going to arbitrage off that risk at some point.
Yeah,
And so,
and sorry, just to chime in, is long-standing gold holders are very aware of this, which is when the paper markets get to a point where they are material, or in case of precious metals, many, many, many multiples the size of the actual physical market.
yep,
Wall Street loves that because it can start just pushing around the price in the paper market, right? And so that was one of the risks that the Bitcoiners, were warned they were going to face, is once Wall Street, productizes this thing,
yep.
it's going to be a lot easier for Bitcoin futures and stuff like that, right? I mean, there's going to be a lot of ways for Wall Street to push the paper price around to where it wants it to be, and you're going to lose a lot of control over organic
Yep.
price discovery. So you're nodding as I'm saying all this, but yeah.
No, absolutely. And what Wall Street loves more than anything else is volatility. And the more volatility an asset has, the more money they can make at it. So Bitcoin is a beautiful asset for Wall Street to basically just arbitrage the crap out of retail
Right.
traders,
Well,
which is what's going on.
volatility that it can influence in the short
Mhm.
term, right?
Absolutely.
So I can push it some way in a given day, right? And I can force the market to react to me, right?
Yep.
And that's, yeah, exactly.
Which is unfortunate because the whole idea of Bitcoin originally was, and again, and again, this is the failure of foresight by retail traders. Bitcoin was great when it first came out because it was truly decentralized. It wasn't tied to anything. But as soon as you started begging for futures and options and ETFs and all you did was centralize the whole Bitcoin market into the markets. It's now just a Wall Street asset. And eventually Wall Street will just arbitrage most of this volatility out of the market. So, probably in the future, you won't see the volatility swings. I'm talking about 5, 10 years from now. You won't see these type of volatility swings of Bitcoin. It'll become a much more stable asset with kind of normal market returns.
Hmm. With that, just the Bitcoiners would say, well, that's good. In many ways, that'll be a good thing because then we can start actually
Mhm.
getting the currency part of the cryptocurrency back into
Yeah,
the equation, right?
yeah, because again, you can reduce that volatility risk to a point, and then and Wall Street will be good for this. They'll arbitrage most of that volatility out of it, so that now I can go. This has been one of the problems. Like, we saw title companies try to use Bitcoin for settling titles. Tesla tried to do it for settling cars, but it was too volatile, so they couldn't do it. But if you can arbitrage a lot of that out, that actually gives you the stability that you need in price, so you can actually start tying real-time transactions to that as a currency hold, right? So
Right,
yeah,
right.
absolutely.
Oh, okay, so that's potentially many years out here. Um, in the here and now, what's the future of
I
Bitcoin looking to you?
you're coming down to a pretty decent support level. Last time we were down, this is around 76, 77,000. That's the kind of this kind of previous top back over here. Then you got these bottoms that we put in kind of in March of this year. This is decent support level here. You're very oversold on a momentum basis. You're very oversold on a relative strength basis. So if you're looking to buy Bitcoin, I would be patient here. I would wait for a couple of days. I'd like to see this kind of bottom and maybe turn up again. Don't worry about trying to buy the exact bottom. what you're looking for is a little bit of this thing to turn up here. But you got a decent entry point for a trade. I wouldn't necessarily buy this right now for a major long-term investment because you've got a lot of breakdown here going on the market. So there's a lot of what's called trap longs in Bitcoin right now. And that's all these kind of traders that were, retail traders, retail investors, all the ones that were buying it back over here on the dollar debasement trade and all that, they're trapped in the stock right now. So, or in Bitcoin right now. So you're going to get a rally back and they're going to clip out of this, right? They're going to, these trap longs are going to sell out. You get another downturn potentially, in a month or two, maybe three. And then that forms the actual bottom to where you can actually make a longer term investment. But I think there's a reasonable trading opportunity here where you can buy this here, get a nice bounce back up towards 100,000, and then you get another pullback before you actually find a bottom.
Okay. Yeah. I mean, to our previous discussion, we're now quite far below all of the moving averages.
Yeah.
And so
This
that,
is
that
the
rubber
inverse
band
of
will
the
start
market.
working in the other direction, right? Yeah.
Yeah. Yeah, but again, this is a really great example of the technicals, right? You extremely deviated above the long-term moving average. Now you're very far below it. So, again, you're going to get this mean reversion now back in the other direction.
Okay. All right. All right. Let's hop out of the chart. I want to
Sure.
bang through a couple of other big topics in the news here while we can. I do want to talk a bit more about the concerns that are being raised about the AI complex.
Sure.
And you've written a piece recently, Lance, about how the capex spending is sort of masking other more concerning things that are going on in the economy. So I do want to trundle into that. But real quick, you mentioned something earlier about what seems to be driving the market in the immediate term here is the will they, won't they on if the Fed's going to cut in December.
Yeah. Yeah.
And so we did get some jobs numbers this week. We got the September jobs number. I think we've been told we're not going to get the October jobs
Yeah.
number,
The,
right?
the BLS could not do their phone surveys. So they don't have any data, household survey data for October, so they will not release an October report.
Okay. Um, anyways, the data we did just get is the September data, which surprised to the upside. I think it was literally like two times the number
Mhm.
of jobs created than folks thought. I think it was around 100,000, and folks were expecting around 50,000 or so.
Right, right.
Now, at the same time, the unemployment rate crept up to 4.4%. Um, and people are basically saying, hey, look, you got to take the jobs there with a big grain of salt because we know both the government shutdown in October, but we've also heard a lot of layoff announcements, over the past 45 days or so,
Yep.
that the September numbers don't capture. So, it's you know, people can look at that data and read what they want into it, right? Oh, well, the jobs number was higher than we thought, and so therefore Fed has less reason to cut here, right? But then unemployment rate's creeping up. Well, the Fed should care about that, right? So I think the last headline I saw this morning was that there was another Fed, some member of the FOMC who said, well, yeah, maybe we might want to actually think about cutting again. But this, you know, will they, won't they switches pretty much
Yeah.
by the hour here. What are you thinking? The last I looked, which was yesterday at the CME numbers, CME forecast was that I think it was like 2/3 probability that it was going to remain unchanged. That
Yeah.
was up, I guess, from 2 weeks ago, where it was more like 50-50 that they were going to cut. But anyways, what do you think at this point?
Well, Wall Street's generally pretty good about kind of predicting stuff, but I think it's kind of a coin toss, honestly, because if you take a look at a lot of the real-time economic data, it's not it's not terrible, but it's not fantastic, right? I
Hmm.
mean, we probably, printed 50,000 jobs in October. And the problem with the September report is, and always that data is so outdated now. We can look back at it. It was 119,000, but how good was that data collection? Based on everything else that was going on at that time. We were going through the whole
And
government
that's on
shutdown.
top of our
Yeah,
skepticism of just the BLS
yeah,
in general. But yeah.
exactly. So yeah, but again, you take a look at the other data. And again, 1 month's of data again is also not important. Numbers are volatile. You get the birth deaths adjustment, which is always BS anyway, but that always inflates the numbers to a degree. So the trend is more important. What's the trend of the employment data? That's clearly negative. It's clearly heading towards zero at some point. It's just a question of when we get there.
Yeah.
So,
Sorry, by the
so
way, I should note too that the payroll data, which was materially higher than expected for September, they also went back and revised the August numbers from a beat to a loss.
yeah, exactly. And so again, that's what I'm saying. I don't put a lot of weight on that data because it's so outdated. The other data I think is more important, and that was kind of the point of my article today, talking about how this AI data center spending, which is boosting economic activity, it's also masking over a lot of the other economic weakness that we see going on across the board. Because again, if I build out a data center, I'm hiring construction workers, I'm hiring electricians, I'm hiring trade skills, right, to build those data centers, but that doesn't necessarily translate all the way over through people owning restaurants and people working in office jobs and those type of things. And so if you take a look at the broad swath of the economy, there's a lot. The economic strength is not as robust. Again, take a look at the Atlanta Fed GDP now as an example. They're at 4.2% real growth for the third quarter. That if you take a look at a lot of the other economic data, it doesn't suggest that we're not seeing booming economic growth across the broad spectrum of the economy. Because you got auto delinquencies rising, you've got default rates of mortgage delinquencies that are rising. You're seeing a lot of pressure on a big bulk of the economy that's not being really fairly represented by what's going on with just construction spending.
Yeah, so Lance, I don't know if you saw it, but had a really interesting interview this week with Craig Fuller, who's the CEO of FreightWaves.
Yep.
They're like the leading provider of data to the supply chain industry about things just to get shipped, whether it's a truck or a train or a ship or whatever.
Right.
And he is very emphatic that the real economy, the economy of moving real tangible things from point A to point B, is in recession.
Yep.
And it's just not, the prospects are not, he's not seeing any light at the end of the tunnel, right now. And what was interesting, a stat he pulled out there was, and he totally says, yeah, like you, hey, the all the capex spending is pulling the averages up. And he said, sadly, everybody in a position of decision making in Washington, running the country, is looking at the averages and looking at the stock market and saying, well, everything must be great, right? And he's like, they're ignoring this real weakness in the larger swath of the economy that still depends on atoms versus bits.
Mhm.
And he's like, and the problem is those are the guys that could actually do something about it, but they're not, because they're telling themselves that everything's great right now because they're looking at these averages that are getting pulled up by all the hyperscalers. But he mentioned a stat. He said if you look in kind of the Mag 7, 10, whatever, those companies employ about 2 million people, which isn't insignificant, but it pales in comparison to the roughly 35 million that he puts in the sectors that he monitors.
For sure.
And he's just like, we are, it's almost kind of like a Potemkin economy, right? Where it's got this facade that everything looks great. And again, things are amazingly well for
Yeah.
those hyperscalers, right? So I'm not denying that there's not a ton of revenues being made there. But
It's not everybody.
yeah, it's not everybody, and I think it's not the majority, Lance, which I think is the really key part of this, right?
Right.
So, anyways, I got one more thing to say about that interview, but real quick, what's your reaction to that? I guess the question is what are the perils of ignoring that?
Well,
Do we
here,
just shrug our shoulders and say, well, hey, those people don't really matter anymore? That part of the economy doesn't really matter anymore?
no, absolutely it matters. And that's my point. But this is also my big concern about next year, right? Just talking about earnings expectations next year are exceedingly high. We're gonna, FactSet's predicting like $320 a share by the end of next year for the S&P 500. But if you take a look at the breakdown, they're saying, well, the big cap tech companies, their earnings growth, you're talking about Nvidia, Microsoft, Tesla, those guys, their earnings growth is going to slow down. But the Russell 2000, the small and mid cap companies, their earnings are going to explode next year, right? They're going to be up 60%, 59% next year. This massive, earnings growth for the S&P 500 or for
What's
the
the
small.
rationale for that?
Sorry.
What's the rationale for that?
Well, that's my question. So where does the earnings come from for small and mid cap companies? Now we're talking about companies that, are retailers, they're, your smaller manufacturing companies, those type of companies. So where does the bulk of their revenue come from? It comes from consumption from consumers. And if you're looking at the economic data and we're talking about, hey, the slowdown in the economy is very real. Take a look at the employment data, take a look at the ISM services index is slowing down. There's not a lot of growth there. So how are you going to generate that? But here's more important to that. So this shows 24, 25, and 26. So light blue, dark blue, and this kind of, I don't know what color that is, another blue. Um, but in 2024, we had booming economic growth. The economy was going gangbusters in 2024 because of all the stimulus that we had going on. They had negative earnings growth. In 2025, the economy is doing great. They grew at 1%. So now all of a sudden they're going to go 60% as the economy is slowing down. That makes no sense whatsoever. But that's the expectation from Wall Street on the markets. That's my big concern going into next year is this idea that the economic growth we're seeing, from AI spending, which is a very small segment of the overall economy, is somehow going to create this massive economic expansion. We may see that in the actual GDP numbers. This was a chart that I published in this in the article I just posted. So this is nominal GDP with and without capex spending, and there's just a big gap. A lot of this lift that's going on right now is because of this AI capex spending, but the actual economic growth rate in the underlying economy is slowing down. And as we get more into again, this goes back to my concerns for 2026 and 2027. I think we're going to see slower economic growth below the surface. We may get some good GDP prints because of AI, but I think below the surface, we're going to continue to see this degradation in the vast majority of the economy, this downward pressure, job losses. We just talked about on the radio this past week. We're seeing energy companies, the big major energy companies, laying off workers because of AI, and they're able to start doing that. So that whole job loss issue that you and I have talked about before, because of the productivity increases from AI, is going to weigh on the economy, which is going to weigh specifically on the small mid cap stocks. So that's one of the bigger concerns I have for the next 2 years.
Okay, so I totally get that concern. I share it, and that concern right now you have assumes that AI capex spending continues, at the rate it is, and that these companies continue to feed these hyperscalers continue to really get fat on the trough, right?
Right.
So let's just talk for a second about what if there is a hiccup there, right? So we've seen concerns about the circular funding that's going on in the AI ecosystem. Michael Burry, has gone ballistic on this of late. Just this morning, he put up this massive chart showing all the different flows from company A to company B back to company A.
Right.
He's also talked about what he believes are, if not fraudulent, highly deceptive accounting that's going on in that space. So, and we've seen, what is it, Oracle's debt that got downgraded by Barclays because they were just like, Oracle has put out these capex projections. They're going to run out of money. There's no way they're going to be able to actually buy all that. They're going to run out of money before they do that. So, to some people, this is starting to smell like 2000. And you don't have to necessarily agree with that or not, Lance, but just if there's some compromise in that AI freight train of spending, that just makes this a whole lot worse, right?
Yeah. It's, first of all, just expecting all these companies to pay for it out of cash flow is a little bit ridiculous anyway. So yeah, these companies are going to issue debt. I can issue debt fairly cheaply in the financial markets. Why wouldn't I do that? Because I have a whole lot of advantages. When I build with debt, I have a lot of tax advantages with that as well. So why wouldn't I do it? And again, I have to make sure I have enough cash for my buybacks, because you haven't seen one company come out and say, hey, we're going to cut back on our buybacks because we need more cash flow for build outs, right?
Right.
We haven't seen any of that yet. So
But
don't
that
worry.
squeeze might be coming, right?
Well, they're going to protect their buybacks. Trust me. That's
Yeah.
how
Well, then if
that's
they
how the
do, then that
insiders.
then limits the spending, right? I mean,
Yeah,
so
but that's why they'll eventually turn to debt. But but we're going to see debt picked up across the board. I mean, there's a lot of and I've seen a lot of the headlines you're talking about lately. And what they're missing is they're assuming that these companies are only going to go to the public debt market. Public debt market is a cheap way to finance, and it's an easy way. So companies like Oracle can go to the debt market very quickly. They can raise debt. Their default risk right now is like 1.6%,
Hmm.
with their debt issuance. So there's no real risk there. So people will loan them money. But for companies, say, and I'm not making any specific examples. I'm just picking one up, right? Just for example purposes only. I'm not making any statements, so don't go off on me. But say a company like CoreWeave, and they want to raise debt, so they've got a couple of choices. They could go to the public market as well. Their rates might be higher than say Oracle because they're a much smaller company. Financials aren't as strong. They don't have the fundamental backing that Oracle does or the history. So maybe their financing debt is higher in the public markets, but let's say they can go to the public markets. The public markets like, yeah, we don't really want to do it. Don't forget, there is a massive private credit market out there that is
Hmm.
sitting on $1 trillion or $2 trillion worth of capital that are looking for deals. So there is plenty of capital on the debt side, and not to mention government side, that is going to be funding some of these build outs that need to get done through debt. So I think and again, yes, there are some similarities back to 2000, not denying that at all. But again, as I said earlier, it's probably a bit early to be going, okay, now we're about to have the dot-com crisis. We're very early into this phase. This can potentially run for 2, 3 more years before it gets to be a real issue.
Sure, sure. And all I was just saying is that if there's something that A, either compromises
Yeah,
that capex spend
absolutely.
out, that makes your concerns for 2026 a lot worse. And also, even if the
Absolutely.
capex continues, but if there's a price correction in the
Mhm.
AI sector and we get a negative wealth effect coming out of that, that also makes things a lot worse. Again,
Yeah,
I
absolutely.
have no idea
Yeah,
if that's going to happen. I'm just saying it is an additional risk factor out there to the one you mentioned.
absolutely. Absolutely.
Yeah. Okay. Um, okay, I do want to talk to you about private equity real quick, though, just back to Craig Fuller for a second. I was thinking about making this a rant, but I think enough people have watched the video with Craig. And folks, if you haven't, you really should, both for what Lance and I already talked about, but for this point as well, especially if you're going to be traveling anywhere on the highways over Thanksgiving. So we got on to talking about how in COVID, um, there was a tremendous amount of demand for shipping, right?
Mhm.
We had these, compromised supply chains, but everybody was ordering stuff from home, right? And so there was a big demand for additional drivers, and so this was, I think, a component of the prior administration's, hey, well, let's get these illegals to come in and fill these jobs, right? We can
Right.
put them to use. We put them to work. So, by Craig's estimate, there was about 600,000 drivers that have been hired who should say have no business being hired in terms of their
They weren't
proficiency in
qualified.
driving a
Yeah,
truck.
they weren't qualified CDL drivers.
Exactly. And so there also was this proliferation of these CDL licensing schools that emerged that basically, kind of give rubber stamps commercial driver's licenses to people who can basically, fog a mirror and that's it, right?
Mhm.
So these were people coming in from other countries, in large cases illegally, who have never driven a truck before. In many cases, don't understand English. They're from countries with different traffic laws, in some cases non-existent traffic laws, and they come in, they get a license, or they pay someone to take the test and get a license, or they just pay for the license without even taking a test. I mean, there's so many ways to get a commercial driver's license, it sounds. And they're able to get behind a wheel of these big rig trucks, really never having driven a truck before. And then they're doing two things that are really scary. One is they're working for lower wages because they're happy to get them. They're way more than these folks were going to get in their home country. Um, and they're willing to drive a lot more hours than the average American trucker
Mhm.
is allowed to drive. So I think, if you're a legal trucker here in the US, you can't drive more than like 10 or 11 hours a day. It's an industry regulation. These guys, they don't care, right? They're going to get paid more the more they drive, right? So they're driving upwards of like 20 hours a day, right? So the two things they're doing are they're undercutting the legal operators here in the US. So you've had now kind of an overcapacity in the system, and it's the guys who are playing by the rules who are starting to go out of business here,
Right.
right? So that's bad from an economic standpoint. But of course, it's way worse from a public safety standpoint, where you've got hundreds of thousands of these people on the road, again, who don't understand the traffic laws, who in some cases don't speak English, can't read the street signs, stuff like that, who may be on their 19th hour of the day driving. So, sleep deprived, and a lot of them are on some sort of chemical substance to try to stay awake, right?
Yeah.
So it just petrifies you in terms of, the road safety risks that this presents. And then the other thing Craig was talking about is that the trucks that they're driving aren't that well maintained. I told this story of my move to Nevada when I drove the largest U-Haul that I could rent, and how petrified I was about how unqualified I was to drive that thing. And of course, that's small. It still drives more or less like a van, not like a big truck, right? So a regular person can kind of drive it, right? And Craig was telling me, and hey, in that U-Haul, which probably wasn't super well maintained, he's like, that's substantially better maintained than a lot of these rigs that are out there on the road right now. So just a super eye-opening perspective in terms of both what's happening economically in the economy of real things, but also just, as we're all going to be traveling, most folks watching this are going to be traveling for Thanksgiving. Just be really mindful on the highway of the big rigs around you, and maybe give yourself a little bit of extra cushion than you otherwise would have, just in case you happen to be driving next to somebody who maybe really shouldn't be behind a wheel of equipment that large.
Yeah.
All right, so I thought you were going to have a lot more to react to that, but okay.
No, no, no. I mean, it's like it's yeah. I mean, as I was just looking up some stats while you were talking, and you have about 5,000 people annually killed in the U.S. by 18-wheel trucks, and that's in total, right?
Right.
And
And sorry to interrupt, but I think it has doubled since 2019. Craig
yeah,
was telling me
it's
because of this factor. Yeah.
yeah, no, it's gone up a lot, but it says the majority of these accidents are the occupants of the other vehicles. You're just not going to win the fight with an 18-wheel truck driver. That's that's the whole
There was an accident that happened about a month ago that was in the news down in Southern
October.
California. And,
Yeah,
and it was a guy who, it turned out I think he was drunk. He was, but
yep,
under the influence. But exactly one of these guys, and they showed the dash cam from his truck when he plowed into stop traffic ahead of him, and the cars that he hit, they just vaporized.
yeah.
I mean,
You
the
just
kinetic energy of this thing slamming into, a regular sedan is just mind-boggling.
Yeah, and that's the real issue is that you know the average and this has always kind of been one of my bitches about, like, for instance, I live in Houston, right? So we have this main highway through Houston that's Interstate 10. It runs all the way from Florida to California. But you've got these 18 wheelers that are just barreling along, this, freeway, and then you've got idiots that are cutting in front of them, trying to get around them, all this other stuff. I'm like, you're gonna lose that fight with that
Right.
truck. I've always kind of been a proponent, like you should have a dedicated lane for 18 wheelers. They should be in the right-hand lane. That's them, that's where they are, and let the rest of traffic flow around. But it's the responsibility of those drivers is so much more important. But again, you have to, the other drivers on the road have to be responsible too. And I like, for instance, I was reading the article about the October event that you were just talking about. But what I see on the freeway is I see people, they are trying to get around an 18 wheeler. Well, they cut directly in front of it. And we talked about a train, trying to slow a train previously, about the, like, relating it to the market. You can't stop an 18 wheeler, you know, on a dime because they have so
No.
much weight behind that truck. And these people are just jumping in front of them and thinking this 18 wheeler is going to stop. And if they jump in front of them and have to slam on their brakes, they're done. That 18 wheeler is just gonna vaporize them as soon as they get hit. So, it's you've got to be people take for granted how dangerous 18-wheel trucks are when they're on the freeway, and they're just cutting around them, doing all those type of things. Hey, I get it, but it's a good way to die.
Yeah. All right. So thoughtful money public safety announcement, folks, this Thanksgiving, just be extra careful on your drive if you're on the freeway here. All right. So private credit, real quick,
Yes.
Lance. So you mentioned how big of an ecosystem it has become. We've talked a bit about, some of the recent defaults that we've seen going on there,
Mhm.
whether it's what First Brands. There's another
Tricolor.
one that came out around the same time, and
Tricolor.
Tricolor. Then there's what Renovo. I think that's
Yeah.
another company that basically kind of went to zero. Um, so, what's your level of concern right now about this? Because that's where the credit markets are where all the marbles are, right? And we don't really know so much the quality of lending that's been done in the private credit market because it's not regulated like the private credit space is. We've been hoping these guys have been making good loans, but we don't know, right? We're starting to see some evidence that, hey, they probably weren't. And, as some of these other potential stresses crop up, then those might put additional pressure on lenders that borrowed in the private credit space. And as they weaken, other stuff starts to happen here. So you've seen things like the stocks of the private lending companies have really performed pretty poorly over the
Mhm.
past 2 months or so. And it seems to be that the market is sniffing out that, okay, these guys maybe some percentage of their loan book isn't great, right? Um, is this just sort of, regular sort of business as usual and the market will cleanse the bad debt and they'll make better loans going forward? Or is this is there a risk here of this being bigger that, hey, there's been a lot of bad stuff and we just won't know until the bodies start floating to the surface? And yeah, we've seen a couple yet, but maybe there's a lot more to come.
Well, so a couple of things are is that what we've seen so far is a very small amount, right? Like auto loan, the subprime auto loans. Immediately our first reaction is like, oh my God, this is like 2008, right? It's a subprime crisis all over again. Much different because of the magnitude of what went on with subprime mortgages. So
Yep.
so there, I just want to state there's a big difference on just the magnitude of what we're talking about. But what's going on with companies like Affirm and Klarna and a lot of these buy now, pay later firms, and what we're seeing going on with a lot of some of these other private credit lenders is certainly concerning. And again, this goes back to what we are saying earlier is that, and again, you take a look at Klarna or Affirm in particular, certainly clear evidence that, and we don't have a lot of data, by the way, readily available on all those buy now, pay later loans. We really don't we think there's several billion of that out there, but we really don't know for sure because we don't have any good data on it. But we know it's out there.
Well, no, there's billions and billions out there, and
Yeah.
I just know because um, Blue Owl bought PayPal's buy now pay later book in the U.S., and
Yep.
then I just realized KKR bought um, PayPal's buy now pay later book in Europe, and I think collectively they're somewhere around like 80 billion, and that's
Yep.
just PayPal's version of buy now. It's not even a firm or Klarna.
Right. And so again, but again, that's again, we don't have like, I can't go to, if I want to know how much treasury debt's outstanding or corporate debt, I've got a data feed for that.
Yeah, but this is the problem with the private credit market is it's unregulated. We don't have
That's
this
my point.
transparency. Yeah.
Yeah, exactly. And that's kind of my point. So it's
Yeah.
a
I
little
was
bit,
just saying it's bigger than just a couple billion.
yeah,
We
yeah.
know that.
We do know that. Yes, this is true. But my point is that what I think we are seeing though is again, you take a look at some of these companies that are in that space, they're under a lot of pressure because the consumer is slowing down. This goes back to what I was saying earlier is like you look at the bottom of the economy, that bottom 50, 60, 70% of the economy, they're not doing great. The top 20% of income earners are floating 50% of consumer spending right now.
Right. And
So
sorry to
that's,
interject, but we've just heard from companies like Walmart, which had pretty good earnings,
yeah,
but a big part of that is because of downshifting. They're getting more affluent customers
that's
starting
right.
to say, I can't spend on my big brands anymore, so I guess I'm going to
That's
start
right.
shopping at Walmart, right? So I mean, we're seeing
Exactly.
even that top half is starting to show some signs of weakness.
Exactly. And so again, I think there is risk. And this is why if you're investing in the private credit market, you need to be very careful about what you're investing in. There's not a lot of clarity in private credit. There's not a lot of clarity in private equity. And particularly in those funds. they don't have to mark to market. They kind of market what they think the asset value is. And so there can be a super big difference between what they're telling you the value of your holding is versus what the real value is if they have to go fire sell it in the markets. So you need, if you're investing in this space, it may look all fine and dandy because they're going to present you these best rosy returns like, oh, you're going to make 18% a year on this. You need to really understand what you're investing in because there's a lot of risk there that I don't think is floated. There's a lot of bodies that haven't floated up to the surface yet that I think
Yeah.
we'll see over the next year or two.
And that's where I was going. So let me just ask you, and I'm just asking you to guess here at this point because we don't have the data, but like, what is your worry factor about this?
In terms of people invested in private credit or the overall market, what do you mean?
Yeah, yeah. In terms of 6 months, a year from now, we're talking about a market freak out because people are realizing that there's a lot more losses in the private credit space, and you start getting a contagion. I mean, for me, the unknown about private credit is you know, different from 2008. Subprime is different, but what it did is it started counterparty risk concerns. It got people saying, wait a minute, and now I don't know where all the bad loans are. So now I'm going to stop lending for a while, right? And that's when things really get wonky, right? And so what's the potential, or in your gut, what's the potential of private credit to potentially spark a counterparty risk freeze?
I don't know if because counterparties are between banks and private credit is kind of sitting outside of that. There
Sorry,
may
sorry to
not be,
interrupt, but just in your answer, address this. I've heard that, hey, actually, banks do lend to the private credit
they
industry, so
do.
they're not like totally separate.
Right. No, no, I was about to say is that there
Okay.
is leverage that's going on that the banks provide.
Yeah.
So again, this is the whole reserve, issue that we've talked about recently about how the Fed creates reserves for the banks. The banks then loan that money to hedge funds, private credit funds, et cetera. So, that money gets created, money gets created through loans and it gets created out of those reserves. So absolutely there's leverage from the banks provided to these private credit funds. So yeah, there's certainly risk. It's hard to assess how much risk because again, I don't want to paint all private credit as bad credit. That's not the
Right.
case. All private equity is not bad.
Right.
Um,
Not all high yield junks or high yield bonds are junk.
yeah, exactly. So some of them are, but you
Yeah,
know,
some are.
but yeah, but again, you do have to be careful about what you're invested in. But yeah, I think there is a risk if you start seeing private credit fail and starting to see more and more. This is certainly going to post concerns up for the rest of the market. Then and you're going to get a repricing of both credit and equity at that point because that's going to be a reflection of what's happening in the underlying economy. I think you're going to see the Fed stepping in to bail stuff out, cutting rates, restarting QE, the typical playbook. Again, at that point, you're not going to want to be heavily invested in equities if we get there.
Okay. Well, one man's opinion, but if I were to bet on, one of the areas of private credit that I think is going to blow up at some point, I'm putting my money on buy now, pay later.
Oh yeah, you and me both. You and I have been there forever. I think that's the most stupid thing ever invented, but we'll see.
Okay.
Maybe I'm wrong. We'll see what happens.
All right. Can we take a few minutes and have you walk us through your new oil and gas portfolio sleeve there in SimpleVisor?
Yeah, so we had so for a while we've been kind of looking at this whole power gen kind of issue that's going on with the markets and the demand for power that's going to be needed by AI companies as well. And we're starting to see kind of now, we had this whole kind of, move over the last several years about more wind, more solar. We need more renewable energies. The problem with those is that they're not reliable enough and they're not efficient enough to provide the power needs for these AI data centers. So now there's this concerted effort to move back towards coal and oil, which is going to be the major energy sources for these AI data centers as they occur because they're so
Well, gas. You didn't mention gas, but that's a huge part of that, right?
gas and coal. It's all when I say oil, it
You
includes
said
gas because
oil.
gas is a
I knew you
byproduct of
really meant gas. Yeah, which is
oil.
why.
But
Okay.
anyway, but yes, all three of those. And of course, nuclear is going to be very important in that equation as well. And but the problem with nuclear is it just takes so long to get there, right? We're just starting to try to get fast track plants to get going, et cetera. And that's going to be 3, 4, 5 years before we actually get a plant up and running and built and those type of things. So That's going to be a very, nuclear is going to be a very important source, but it's pretty far out there. So
Yep.
again, what we're seeing companies do right now is they're trying to locate next to gas pipelines. They're trying to build as close as they can to a gas pipeline so they can do what's called behind the meter. And they can tap into that pipeline for natural gas to power these data centers. And but that even takes a year or two just to do that. So even in front of that, they're going to LNG to provide power near term for the data center so they get the data center up and running until they can tap into the natural gas pipeline because they got to run
Hmm.
the pipeline close to the building, tap into it, those type of things. That's a year or two. So there's a time issue for all of this, and this is all going to provide a lot more demand on the oil and gas sector. And so one of the things that we've been thinking about is, and again, this is a very early stage deal. This is not something you don't go buy a bunch of oil and gas companies today because they're not performing well right now because oil prices are fairly low. And I think oil prices can potentially go lower here before we get to a bottom in oil prices. I think we get closer to maybe, $40 a barrel once we get there. But there's going to be some time getting there. But, we started building out this portfolio structure and with this idea of something that we can build into over time. So we launched this thematic model that's based on energy. And, so today it's up like 42 bips since we launched a couple of days. We launched this last Thursday. No, yeah, last Thursday we actually launched this. So it's down about 2% over the because it's going to travel with the market anyway. But this is all related back to just energy sectors, energy specific companies. And so we've got everything from drillers like ConocoPhillips to natural gas pipeline companies like Williams, which is one of the bigger pipeline companies out there, ExxonMobil, Chevron. They're the ones that are actually drilling oil and gas, producing it, et cetera. Straight drillers like Diamondback Energy, EOG Resources, and then even into the transportation side of this looking at like Scorpio tankers in terms of actual transport. And of course, Cameco Corporation for the uranium for nuclear power companies. So it's looking at kind of the entire energy space and picking companies that we think will participate the best longer term. But again, this is not something that's going to be like you're going to invest in this today and it's going to make you money today. This is an outlook, a thematic model that will be something that we just slowly build into over the course of the next 18 to 24 months.
Okay. Um,
But this would be a great portfolio if you wanted to that you start out with like $1,000 and you just start dollar cost averaging into it over time. That's a great portfolio for that type of thing.
yeah, and that's where I was going. So we've had, a number of I would call micro discussions on this channel recently about how the energy sector has been really beaten up in recent years. And there's both, the hey, we're going to need all this new power to power the AI era. So
Mhm.
when is that going to start adding a tailwind to the energy sector? And then we've had kind of the Rick Rules of the world who have just said, "Hey, look, like we've underinvested in capex in especially a lot of these fossil fuels, and even if global demand for oil and gas just sort of stays where it is, we're going to have some shortages at some point. And of course, the lower that the oil price go, you think it could maybe get down into the 40s.
Mhm.
These companies don't go out and explore and develop at those prices. They just sit,
Right.
right? And so that then eventually leads to scarcity, right? So the question has been, or a lot of people have been raising is okay, well, look, is this a good time to start getting into this space so that when it gets out of bust and goes back into boom, you can really ride that? Um, Sounds like that
And
this is exactly why you guys created this portfolio.
yeah, we do. But again, that's exactly my point. So if you went to SimpleVisor right now and said, "Oh, I'm going to get in this portfolio," and you go, stick all your money in this portfolio, you could be disappointed for a long time. I mean, this may do not. I mean, it has a really good dividend yield to it. It yields close to 4% because of the companies that are in it. But you're going to be just kind of sitting on potential losses for 12, 18 months before potentially I don't know when this thing is going to turn. It's going to take time. But when this eventually turns, it'll make money. So this is why, like even with our accumulator model, if you're just trying to get started out investing, these are great models that, hey, I like this thesis long term. I'm willing to suffer the slings and arrows over the course of the next 12 months. If it goes down 10%, I'm not going to freak out and sell everything, right? I'm just going to keep dollar cost averaging into this because over time, the thesis should work out. There's just a supply demand imbalance that's going to have to get met at some point in the future with the energy and with the energy grid in particular. But again, it's going to take a couple of years potentially to get there. It could come a lot sooner. Maybe this whole thing catches on. Everybody starts buying them next month. Maybe it works out great.
Right.
But just from the fundamental basis behind it, it's going to take time. So it's something that you dollar cost average. It's a small part of your portfolio. It's 3, 5% of your total net worth. And it's something you just dollar cost average into over time.
Okay. So a couple of things you mentioned there. So uh, because we don't know, like this could catch fire tomorrow, right?
Yeah,
Not your default assumption, but could, right? Which is why you want to start building a position, right? Because if it starts taking off, you want to have at least some skin in that game. Now, I think you're doing the right thing and saying, hey, look, we don't know, and there's a lot of, still headwinds the industry's facing. So set yourself up for expectations that the price could go down from here, right? And so that is a nice dollar cost averaging opportunity, right? If you think the long-term potential is there, but you don't know when it's going to turn, well, just start nibbling in, let dollar cost averaging let you lower your entry price over time. And then when the turn comes, you'll have a nice, entry position that should ride that wave, right?
yeah,
Um,
absolutely.
Now, presumably, I think, Lance, and I don't want to put words in your mouth, which is why I'm asking you this. Um, at RIA, your intent is to try to capture 80% of the upside while only getting exposed to 20% of the downside, which means you're not going to go all in on the energy space at the exact bottom because you don't know where it is. But you're going to be looking for technical and other indicators that will eventually let you say, oh, we see now that we think, high degree of certainty the bottom is in our rearview mirror. We think this thing is turned. Now it's time to start increasing your exposure. So presumably at some point you would come on this
Yeah,
channel if you saw that and say, hey, I might switch from just dribbling in dollar cost averaging to start increasing more in this
sure.
space if I really believe in this thesis,
Yeah,
correct?
and but for instance, in our kind of our broader macro core models, we already own companies that are in this space. So like we own GE Vernova, we own Kinder Morgan Energy, and others. And so even in our core models, we're already making those energy bets there, and they're fairly small positions, but we'll start grossly increasing those as well. But yeah, at some point, if we begin to see oil prices turn up on a sustainable basis, and we're starting to see those type of drivers and starting to see that real impact coming in. Yeah, it's like, yeah, this is, we're going to be like in our core equity models, we're going to be adding more energy. We'll be increasing the overall energy sector weighting, but that'll also be the time to start aggressively, adding money into an energy specific portfolio.
Okay. All right. All right. Well, look, we're starting to wrap up here. I'll do a quick, see if we can do a quick rant, and then we'll wrap things up. Actually, real quick before we do, trades. What trades, if any, have you guys made at RIA in the past week?
None this week. We came into this kind of in a pretty good position. Like I said earlier on the show, our portfolio is down about 1.5% versus the market 3.5. So, really not a lot to do. We carried a really good balanced portfolio up to this point. So days where Mag 7 hasn't worked, like for instance, a good day, a good example is yesterday. Nvidia was down 2% at the end of the day. Walmart was up like 4.5. So, that we have these different positions in the portfolio that tend to offset each other. So if I have a bad day in one position, I've got another offsetting position. We talked a couple of months ago about healthcare being very out of favor and that we were adding the healthcare stocks. Those have been doing very, very well and have helped really kind of balance the portfolio. So this week we haven't had to do anything. But again, over the next couple of weeks, we're going to be doing tax loss selling, rebalancing the portfolio for the kind of the end of the year and just kind of doing some maintenance and cleanup. So, kind of looking for a bounce here in the markets that might last 2, 3 days. And then maybe next week we'll start doing some of that work.
Okay. But good to hear that the portfolio is performing as intended,
Right.
meaning that even when, some of your high flyers are getting knocked down here, a lot of the sort of stodgy, steadier, eddier guys are providing the ballast that you expected them to.
Yeah, exactly. Yeah. Never count out Warren Buffett.
Okay. I just want to note here, because again, markets are still open. Market has been picking itself up today. Just looking here, it's up about 1.3% or so on the S&P right now.
Yeah.
Bitcoin has started recovering a bit. I think it hit a low of 81,000 overnight. It's now at about 85,000. And Nvidia is green for the day, not by a lot. So
Google, by the way, Google has absolutely been scorching it over the course of the last couple of weeks. That's an area that's one of the stocks we're going to take profits in. Rebalance that one back to target, but
Okay. And how
they're,
much of
they're,
that is Google's general outperformance versus the fact that Berkshire Hathaway just bought some?
that's a little bit of it, but and that certainly helped lift it for a day. But the reality is that their
Gemini?
AI platform, Gemini, is doing very well. And Google makes up 75% of the search market. And one of our bets is that eventually Google's going to win the OpenAI. I don't think ChatGPT OpenAI wins this race. I think Google does, and that eventually Google will have 75% of the AI space as well.
So let me ask you this.
Mhm.
So that's not known at this point in time, right?
Right. Everybody knows that. It's a bet.
So you've got two big things going on right now. You've got AI totally eating into search queries, right?
Correct.
So it's a lot easier just to say, hey, ChatGPT, just give me the answer versus putting your query into Google and having to click on all the blue links, right?
Right.
So that to me seems like a really big, a massive threat to their core revenue model, right? Secondly, there's a bunch of hyperscalers trying to win the AI race, Google being one of them. No guarantee Google's going to win that. So my brain says, well, you got to put some pretty hefty discounts on Google right now because of that uncertainty. Clearly, the market disagrees with me.
Yeah.
What's wrong about what I'm thinking? Oh, and then
Because
there's another third thing, which is even if Google wins and gets 75%, maintains its search share with AI, can it make money off AI the way that it can off of as profitably as the way it's been able to off of its search business? I don't know, because you're getting the answer right away. You're not clicking on a whole bunch of advertiser links.
but Adam, you should know this better than anybody because you used to work for Yahoo. Google went to Yahoo and said, "Hey, we'll sell you our search engine for like $5 million." And Yahoo said, "Nah, we don't want it. We've got our own search engine." And so they launched search.
Yahoo actually used to use Google for a while, but yeah, it
If
wasn't
they had the
just
chance to buy
by our
them
search
cheap.
engine. I think it was by us, and yeah, Yahoo passed.
Yeah, exactly. And so then Google went back to them at one point, said, "Hey, we got this thing going on," and actually Yahoo approached them at that point about buying them and offered them like 2 billion or a billion. I can't remember what the number was. It was a lot. And Google said nope, and they turned around and launched AdWords right after that, and
Right.
basically destroyed Yahoo on the advertising front. So my point about this is that the one thing you don't discount about Google is them figuring out a way to dominate the market. They did it with YouTube, they did it with AdWords, and they did it with search.
Yeah.
And
Although
my
they bought
bet,
YouTube, they didn't create it, but yeah.
yeah, but then they turned it to the monster it is today. But at the end of the day, my bet is that they'll figure out how to monetize AI efficiently, like I've done with other. It may not be direct. It may be through another version of like their AdWords or whatever. But this is a company that knows how to monetize a business, and so that's why we own them, and we will probably continue to own them for a long time.
Okay. And look, kudos to Google. They continue to outperform over the years, but I'll just be transparent. This is something I'm having trouble with on them,
I
which is
understand.
I just see layer after layer of uncertainty. And as the uncertainty gets removed, great, fine, give them a big premium. But until then, I'm just like, wow.
Well, see,
What?
here's the problem with that though, and so this is what as being the host of Thoughtful Money that you need to be really careful of because people look at you as a really smart guy and they go, "Oh, Adam knows what he's talking about, so I'm going to listen to him." So when you say, "Well, there's all these uncertainties," your listeners then go, "Well, Adam's saying I shouldn't invest into this, and so I'm not going to invest in Google right now because of Adam's concerns." And then the stock goes up another 30, 40, 50, 60%, and they lose that opportunity. It's okay to I have concerns about this as well, but I know how to invest around those concerns. I can hold a stock that is grossly overvalued, grossly fundamentally disconnected from the market. But as long as the price is trending in the right direction, I can participate and make money on that, which is our job as portfolio managers. And your job as the host of the show is saying, look, I may have these concerns, but that doesn't mean this stock can't go material higher because this company has proven itself over and over and over again to dispel those concerns and prove that they are a dominant leader in the market. And that's the thing I would bet on.
Well, so I appreciate you bringing this up because I mean, just categorically, I don't tell people what to buy or sell.
But
And now I understand that
infer
somebody
it.
can, I understand somebody can make the mental leap that you're talking
Yeah.
about there. And so I'm glad you're giving me the chance to clarify. I'm not saying don't own Google. And I said earlier, there's something I don't understand, but the market clearly doesn't agree with me. And that's what matters at the end of the day is what the market thinks. But this is, again, kind of the emphasizing what is it? The foundational part of what thoughtful money, does here is it brings on professional financial advisors like yourself, because I'm saying, look, I don't have all the answers, and what you want to do if you don't feel like you have them all yourselves, and I think most people don't feel like they have all the answers themselves, is you want to work with an experienced advisor who can deploy all the active management tools that you and your team do, Lance. And so I'm glad you're giving us a chance to really uh,
Well,
to really
and
underline that here.
yeah. And let me clarify my point. So I don't want anybody to infer that I'm saying go out and buy Google
Yeah,
today.
because you're telling everybody to buy Google calls hand over fist now, apparently.
Exactly. This is a weekly chart of Google. And this advance why Warren Buffett actually bought Google here, I'm not quite sure, but he's his own man,
Yeah.
right? So he can
Well,
do
I'm
what
pretty sure it wasn't Warren who bought it at this point. I think it's the new guys, but yeah.
it could be. But, this thing is three standard deviations above its long-term moving average. Historically, when it gets to these levels, you remember I did this same chart on gold a while back, and I said, look, when you have these big type of deviations, you're going to get corrections. It doesn't mean the end of the world. It doesn't mean don't own it. But to buy it here, the real reality and this is why we're going to take profits in it, rebalance it back to portfolio weights, maybe even underweighted a tad, because a pullback to 200 or 220 on this stock is not outside the realm of possibility. That would just be a pullback to the longer term moving average, still being a bull market trend. Extremely overbought on a relative strength basis. Momentum's extremely overbought. Every measure says this stock is going to correct at some point, and it always has. And you need to be aware of that. But on a pullback, if you got the correction back to these levels, I would certainly be a buyer.
Okay. All right. So it's so funny because now you were disparaging me saying, "Oh,
I'm not
there's
disparaging
risk
at
in
all.
Google," and that. No,
No,
I
no.
no, I know, but actually, give me a chance to say this,
Yeah.
which is, I'm going to continue to do this though, which is because of thoughtful money, right? Is my job is to say, hey, here are things. I'm trying to understand this market just like everybody else is, and we're sort of collectively trying to understand this together. So when I see things that don't make sense to me,
Mhm.
I'm going to raise them to you because you may have a piece of the puzzle that I don't have, right?
No, no, and look, and that was the only reason I pointed this out. I'm not disparaging it at all, and nobody should take our conversation right now away as me like, oh, Lance was beating up on Adam. That's not at all. Because, like I said, you're a very, very smart guy. You talk to a lot of very smart people. You're a very smart guy, and people look up to you. And that's the risk you have as a public person, as you are. And we have this moniker of thoughtful money, right? We want to be thoughtful about our money. We don't have a view one way or the other. It's not bullish, it's not bearish. We're trying to tell you what's the right thing to do with your money for your personal situation. And again, this is why you need to go have financial counsel with somebody. Don't just take our word for it, right? Go do your own research, go do your own work. We're just giving you ideas and things to be thoughtful about. And so my point is, Adam, is that we just need to be careful that people don't take something that you say and just infer it to mean something else and then go make decisions that hurt them financially. Because that's the one thing we're trying to avoid. We want to make sure everybody does the right thing with their money long term.
Yeah, I completely agree. And just to expand Lance's point there, yes, don't take anything I say as gospel, and don't take anything that Lance says as gospel or any of the other
Absolutely.
experts on
I
this
don't know
channel.
what the hell I'm doing over
Yeah.
here.
Yeah. And again, folks, again, this is why I think hopefully the value of this program is we do try to kind of scratch through everything and to try to get a sense of a truer sense of what reality might be. But then, of course, it's all about, okay, well, then what do you do about that, right? And the answers to that are very specific to you and your personal situation. And that's why I think for the vast majority of people who aren't excellent DIY investors with a long track record of outperforming on their own, that's where you should seek professional counsel and say, hey, let me educate you about the specifics of me. Now you help me think through what makes the most sense for me, given these insights that we're learning, but mapping them to my particular needs and wants and goals. So, anyways.
Absolutely.
All right, don't need to beat that horse anymore. I think folks got it,
Yeah,
but
that's good.
good,
That
good,
was a
good,
good, that was
good.
a good
It's
rant.
always good
We're
to
good.
remind people of this.
That was a good rant. We're done for the day. Thanks for coming.
Yeah, yeah. Well, here we'll do a micro rant and then we'll wrap it up.
All right.
So Elon Musk was just interviewed and he said that he thinks in 10 to 20 years, that work will be optional and that money may not even really be relevant anymore because of AI, right? That we're going to have robots that do everything for us. They grow our food, they give us healthcare, they delight us with all sorts of forms of entertainment and stuff like that. So it's going to be sort of the Star Trek future of just like, hey, technology will do everything for us and we can kind of be our best selves. Um, and to be honest, folks, I didn't watch the full interview. I've just seen the headlines that have come out around this. So I don't know exactly what Musk said, but obviously this is a guy who's sitting in the epicenter of technology, and he's looking at where he sees things going. Here's two big questions I have for that,
Yeah.
assuming he's right for a second. One is that a net boon for humanity, right? Like people. My opinion. You've heard me, everyone's heard me talk about the three big pillars of true
Yeah.
wealth, right? Which is
So you and I
quality
are both in agreement.
relationships,
Yeah.
health, and purpose, right? And if you remove purpose, right? Because work, our purpose is not 100%, but heavily tied to kind of what we do for a living, right? And if we remove people's need to be purposeful, um, what does that do for society? And yes, we could say, oh, well, it frees us up to learn everything and build these new skills and whatever. We know what happens when we give people advanced technology.
Yeah.
They generally use it for our basest desires, right? We watch porn and cat videos and all that stuff. Um, so
And
so
a lot of times at the same time.
there's that question. And then the second question I have for you, Lance, is if this is true, right? Um, we are changing the human experience. I mean, since the first, you know, uh, Homo sapien crawled out of the cave and had to go get food to be able to eat, at the end of the day, humans have had to do work to survive, to exist, to thrive. If we are removing that, it will be the first time in our human experience where we wouldn't need to do that. Is that something that maybe we should just like have a vote on or something? Like we're barreling to this future with the presumption that it's the right thing to do. But if we're going to change something that is so core to humanity, shouldn't there at least be a national dialogue around this?
The problem is that, and yeah, the answer to your question is yes, sure, right? But then ultimately at the end of the day, you really can't stop what's coming, right? The innovation is coming. It's here. And it's just a function of how it turns out. And George Jetson had to still go to work every day, right? So even though they had robots in the house and everything else, he still had to go to a job every day. So I don't know if
In
he's
that fictional cartoon future.
I know. I'm just saying. I'm just saying. This is all a fictional future. We have no idea what the future is going to look like. But my point is that I agree with you 100%. People need purpose. If I don't have a reason to get up in the morning, there's no reason to get up in the morning, right? And I don't think that's a good outcome because if there's an old saying about idle hands are the devil's work or devil's
Sure.
playground. And to your point, we've proven it with social media, right? We have done the most negative things to society that we can possibly imagine because of social media. I've said this before, is like if Albert Einstein ever came back and said, what was the greatest invention since I died? Everybody goes, oh, look, it's right here. We have all the knowledge of the universe in the palm of our hand. And he's like, well, great. Everybody's very smart now, right? It's like, no, we just sit around and tweet mean things to people we don't even know. That's on the toilet, right? That's what.
Yeah, I'm pretty sure the two things that he would realize when he comes here is he would say, I'm amazed at your technological innovation progress you've made since I was
uh,
alive, and I'm shocked at how dumb everybody is.
Exactly. And so no, I don't. This is like UBI, universal basic income. That has never worked out well. They've run live experiments on this. It did not work out well. People did not become more productive. They did not go out and pursue higher education or other hobbies or anything like that. They just took the income and just lived their same lifestyle, and it deteriorated.
Well, they became dependent. We become dependent. I mean, we've seen that
Yeah.
subsidization of lifestyle leads to dependency, not to elevation. Yeah.
Yeah. And so the outcome of this is not good. And again, what we're going to wind up with in society is a very bifurcated society. There's going to be those that can harness the power of AI. They're going to be able to make money with it. They're going to have the wealth. And then there's going to be everybody else.
This
And
is
so,
my lower I-shaped society, lowercase
yeah,
I-shaped society.
it
Yeah.
is. It is absolutely going to be the case. I just interviewed Peter Atwater. We've got his interview. We're going to run his interview next week. I just interviewed him talking about the K-shaped economy. But this is going to be a K with a very long lower limb going out of it, and it's not going to be good. And eventually, I think people have to rebel to some point. And, I think a really good picture of the future is if you've never seen the movie Ready Player One, you should watch the movie. I think it is a really good prediction about where we wind up in the future based on what we're doing today.
Right. And a fair adjective for that is dystopian. I mean, I don't
Yeah.
think it's a future any of us aspire to get to.
Everybody's super poor except for the people that own the corporations.
Okay. Well, again, like many things happening at the macro level, we don't have to like it. And it might be something that we can't control in terms of what happens, to the average of society. But of course, on the individual level, just like with investing, we can take charge of our own destiny.
Yeah.
And my advice here for folks is learn enough about AI to make it work for you versus against you, but
Mhm.
also, you know, um, focus yourself on, what can I be motivated to do when I wake up in the morning, and, raise your children in such a way that they understand the value of work. And I don't mean work as toil, I mean work as purpose and meaning in your life.
Exactly. Yeah.
Yeah. All right, my friend. Well, look, you know, thanks. Another great week. Happy Thanksgiving again to you and everybody watching. Folks, if you think the best way to inject more purpose in your life is to continue to watch Lance Roberts on this channel week in and week out, please let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Um, I'm about to tell folks to go fill out the form to go talk to you, Lance, if they want to get some guidance. Real quick though, because Thanksgiving is just a few days away, we are getting really close to those year-end deadlines, right? For things like tax loss harvesting and taking your required minimum distributions, charitable giving, stuff like that, right? So it's actually an important time of year to sit down and make sure you're doing all those steps. And if you aren't clear on what you should be doing, then obviously that's something your firm can help people think through,
Absolutely.
right?
Yeah, and look, and please don't wait till the last minute. Every year people like try to come in the last week of the year and do their RMDs, do their distributions, do those type of things. Don't wait. Some of these things have to be done before the year closes out. Otherwise, you suffer potential penalties. And if you get really close to the deadline, these big firms like Fidelity and Schwab, they get backed up and you run the risk of that not getting completed on time. If there's a paperwork snafu or you forget to sign a dotted line somewhere, those things happen. Give yourself some time. If you've got if you're, over the age of 72 and you need to do your RMDs, I would start working on that now if you haven't done it. Doing your tax loss harvesting, your charitable giving. If you need to set up things like a donor advised fund, those type of things, those can be done. They can be very tax efficient. They can be very friendly for you tax wise, but it takes time to set up. So again, give yourself a little bit of time. Start thinking about that now. If you don't know what a donor advised fund, or if you don't know how to do charitable giving, those type of things, and the most tax, because you can donate. You don't have to sell stock and go donate cash. You can actually give stock as part of your charitable donation for the year, but give yourself some time to do it. Don't wait till the last minute so that you get behind behind the deadline.
All right. So folks, if you'd like help with any of those year-end activities or just positioning for some of the more macro, trends that Lance and I were talking about, if you don't already have a good financial advisor who's advising you on that, then feel free to talk to one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. Perhaps you'd like to talk to even Lance himself there at REA. To do that, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds, and the firms will be in touch with you right away after you do that. Lance, my friend, it's always great. I'll give you the last word as usual.
Happy Thanksgiving, and we'll talk to you. I guess we're doing a show next Friday.
If you're game, I'd love to do it. I'm sure folks love to watch it.
I may be fat, dumb, and happy, but yeah, I'll be here on Friday.
All right, I will too. I'll be on the road, but we'll do it. It might be a little bit shorter just to let us spend some time with our families, but I appreciate you being
That's
open to
fine.
that, Lance.
Yeah, no, we can do that. We just do a little short, 30-minute one or something, and just catch up. It's gonna be a light trading week anyway. Markets are closed Thursday and half day Friday, so yeah, we just do something to just kind of catch up where we are.
All right, well, thanks, buddy. Then I'll see you next Friday, and folks,
All right,
you'll see us next week. And everyone else, thanks so much for watching.
At the end of this, it's going to be a silver standard, not necessarily a gold standard. Going back to gold would be better where we are now, but the real end of the inflationary system is when credit is going to collapse. When credit collapses, dollars don't work, and if dollars don't work, none of the other currencies work either, because that's what we say reserve currency, right? That's currency that's in the basement of all these other central banks. So when the dollar falls, or these other currency falls, all credit falls, all credit derivatives, and then you're left with all the purchasing power of all that lost purchasing power gets vacuumed into silver, even more than gold, which is why we're going to go eventually to very near a 15-to-1 ratio, which is the historic exchange ratio, monetary exchange ratio between gold and silver. That's natural economic law.
Analysts note that in a crisis, gold and silver could surge, with the gold-to-silver ratio potentially falling from 90-95 to 1 back toward its historic 15-to-1. Silver's dual monetary and industrial uses, combined with its affordability, may spark strong demand from ordinary people. While fiat collapse isn't directly emphasized, stress from dollar weakness and debt issues could still drive a rush into physical silver. Rafi Farber, also known as the endgame investor, is a financial writer and precious metals analyst. Silver played a central role in global trade for centuries, particularly in China, where taxes were often paid in silver, thereby tying the economy to the metal. This dominance shifted after the U.S. Coinage Act of 1873, known as the Crime of 73, which demonetized silver, hurting miners, farmers, and debtors while favoring the wealthy who held gold. Attempts to restore silver through the Bland-Allison Act, 1878, and Sherman's Silver Purchase Act, 1890, were short-lived, and the system remained gold-centric. Recent scholarship also highlights how silver's volatility, particularly in Ming China, fueled both trade growth and inequality, concentrating wealth among elites at the expense of ordinary people. Rafi argues that societies built on financial theft eventually face a reckoning, just as debts must eventually be settled. In the endgame, silver will likely return to a stable 15-to-1 ratio with gold, forming the base for rebuilding a more honest economic system. Gold and silver are regaining importance in global trade as nations transition toward a hybrid system that blends traditional money with digital tools. Despite slower global growth, metals are forecast to rise over 30%, driven by fiscal pressures and safe haven demand. Analysts also suggest silver could outperform gold due to the historically high gold-to-silver ratio. Before we examine the video, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
A lot of people say, and I think they're correct, that we've talked about the pyramid, right? And gold is at the bottom. But underneath the gold is an even smaller triangle of silver in terms of value. Look, before gold was money, we talk about gold standard and going back to gold standard, and this is what we have to do. But really, it's not exactly that. It's really going back to silver is what we need to do, or what will be done. I understand that, trading silver coins is not economical in the sense that it's very bulky, and you can't actually exactly do that in today's world. But the human civilization started not on gold, but when we really started global trade and continents started trading, and the Silk Road, and Africa started trading with Asia, and you really got a big economic system going, it was based on silver. And what happened in 1873, right, with the crime against silver, or what exactly they call it? I think it was the crime against silver. What happened was, who owned silver back then? It was the poor and the middle class. That's what they used for their money. What did rich people do? How did they store their wealth? They stored it in gold because they had too much silver. They couldn't store it all. And so they had a lot of gold. So what's the best way, if the middle class and the poor, and there's a lot more middle class and poor than there are rich, what's the best way to take purchasing power from the middle class and the poor and give it to the rich? If you're on a silver standard, move to a gold standard, right? That's how you do it. But everything that the government does in order to keep the pyramid going is basically a theft of the middle class and the poor for the favor of the rich. We have to go through a reckoning. That's natural law. Like, just as all debts are paid either by paying the debt or defaulting, all theft is paid too. Because when you steal, that value, when you make an exchange of two people and they're both benefiting, legitimate, when you steal, one loses at the expense of the other. And so you have a net negative effect on society. So when you have a society that operates through these sorts of theft systems, those thefts and those debts are going to be paid one way or another. Now, I have no dollar figure for where silver is going to go in the end game, but I do believe strongly that the end game bell. How do we know when this is all over? Like, the bell's ringing. Okay, well, the dollar has collapsed. It's going to be at a 15-to-1 gold to silver ratio, one that's relatively stable. I'm not saying like we hit it one day, like in 1980 it happened for a day and a half or something. I'm saying this time it's going to stay that way until we can rebuild a basic economic system again. So it could be a year or two, three. I don't know, but I'm saying it's going to be stable enough that silver supplies can filter through the economic system, physical silver supplies, and that figuratively and almost literally creates a base of wider silver dispersal where you can rebuild another credit pyramid, hopefully an honest one where all debts are paid and you don't have fractional reserve or however you think the banking system functions. Well, what does the United States look like? I really don't know, which is why, frankly, I don't want to live here. I don't know what Israel's going to look like either. I'd rather be with my people than being here, precisely because I don't know. I would imagine that states could break off from the federal government. The federal government could dissipate, and you could have regions, different regions. Like, if the South had won the Civil War, you'd have the Confederate States and the northern United States. So it might break into a few pieces. I think there's going to be serious trouble in the very big cities like in LA, New York, Chicago, Minneapolis, where you're from. These places that are morally rotting, they're not going to do very well. But I think outside of that, you will have Americans, and America will exist. The United States as it exists now, I don't know. I can't say yes. I can't say no. It might reorganize into some looser government or Articles of Confederation or something, or California, New York could cede and then leave the more fiscally responsible states into some other union. It could be anything. I just hope that we get through it with the minimal amount of suffering.
Rafi relates that the rise in prices we see today is only an illusion created by the inflationary system. When measured in real money, gold and silver prices have actually been falling for decades. If someone consistently saved part of their income in gold or silver, over time, they would need less of it to maintain or even improve their standard of living. The point isn't to stack metals to cash them out for more dollars later, but to step outside the illusion of the dollar system as much as possible. These metal-focused trends reinforce the notion that the current system creates an illusion of rising prices when measured in dollars. At the same time, real value units, such as silver, offer an accurate preservation of purchasing power. Rafi points out that the de-dollarization movement and individuals turning to gold and silver echo your point about trying to live beyond the constraints of the fiat system. Analysts predicting outsized gains in silver align with the idea that steady savings in metals could result in maintaining or improving one's standard of living over time, even as the dollar erodes. Now, let's recall the interview.
It's not that prices are rising. They only seem to rise within the inflationary system, within this illusory system that we're all stuck in, like a prisoner's dilemma, and we're all stuck in it. Prices are actually, they've been going down since 1960s. I mean, if you look at everything priced in money
And gold.
Money, I mean gold and silver, mostly gold, silver secondarily. But if you look at actual prices, they're going down. And so the prices are only going up if you insist on maintaining your economic existence within the illusion itself. And you could say, okay, fine. So let's say I want to get out of the illusion and just, take all of my salary and just buy gold with it every month. Well, I understand you can't do that because you need to be liquid, and gold is not as liquid as dollars. It would be if we were on a gold standard, but it's not. So then you could say, So then, we are losing out. But it's not just that prices have been staying stable in gold. They've been falling in almost every category. And anything priced in gold is going down. So even if your dollar salary is less, right, then the amount of gold would keep going down with however much you could put away every month. Let's say you earn like $5,000 a month, and you put, $1,000 a month away or $500 a month away in gold and silver over 20 years, and each month it's less and less gold and silver because they keep going up, but you need less and less gold and silver to even have higher standards of living. So you can live outside of this illusion. That's what I'm trying to get people to understand. It's not about stacking and then becoming rich and then using gold and silver to accumulate dollars. We're getting out of the illusion as much as we can. It's like like a drug addict, right? If you're talking to a drug addict, you have to understand how they think, but you can't go completely into their world. But you care for them, so you need to communicate with them in a way that they think that you're on their planet. But you have to. It's a very difficult position where we are, because we have to put a leg in the illusion and we have to keep a leg out of it and keep our minds together, which is it's very difficult even for people like us. It's all the more difficult for people who don't understand intuitively with the confidence that gold is actually money, and it still is today. That was the final piece that fell into place for me. That only I think like in 2022 or something like that, when I finally understood, when it finally slipped into place that everything is really based on gold and silver, and this entire pyramid that we're living on. The higher we get on it, the thinner the air gets, and the more insane we become, keeping one leg in it while trying to keep one leg out. But
Rafi Farber's insights highlight silver's historic and future role as a form of real money, capable of preserving purchasing power and providing stability when fiat systems fail. With de-dollarization underway and precious metals gaining ground in trade and investment, silver's potential resurgence to its natural balance with gold reflects both a historical truth and a practical strategy for navigating today's uncertain financial landscape. If silver does return to a 15-to-1 ratio with gold, what impact would that have on global wealth distribution? How can individuals today best position themselves to step outside the illusion of the fiat system while still meeting everyday liquidity needs? We'd love to hear your thoughts, so feel free to share them in the comments section below. If you enjoyed this content, don't forget to hit the like button and subscribe to stay updated with future posts. Thanks for being part of the journey.
Right now, silver looks weak compared to gold when you go back to 2011 high, but what's been going on for 5 months is a lot more strength in silver. I think that's going to continue, and I think it's going to get explosive. And I think we're going to look down in, a couple months, and we're going to say, oh, wow, finally, the beast is out above its all-time highs. It's like 60 or 70, which is sort of a broad working target we have for the next surge. If gold just stood still and silver went to 2% of it, silver would be $70 or so. But gold will be going up during that time. It's just that silver will be outpacing it. So we think right now the place to be most focused in terms of holding a position. We said that about several weeks ago, and sure enough, bang, we're up through the highs again. I think the game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000.
Silver is gaining momentum and looks set to outperform gold, with analysts expecting it to break past its old highs and potentially reach $60 to $70 as it catches up. Even if gold held steady, silver could rise to around $70 at 2% of gold's value, but since gold is also climbing, silver's outperformance is likely to accelerate. With gold's rally restarting and long-term projections pointing as high as $10,000 to $20,000, the strongest focus right now is on silver within the monetary metals. Michael Oliver is a seasoned market analyst and the founder of Momentum Structural Analysis. He explains that gold has spent the past 5 months consolidating in a sideways range, frustrating skeptics who expected a major correction. Instead of falling, gold held firm and is now breaking above $3,500, signaling renewed momentum. This pause acted as a cooling-off period, setting the stage for the next surge higher. Analysts suggest this rally will be powerful but not the final peak, with potential targets of $10,000 to $20,000 in the long term. Silver and gold miners are also showing strong outperformance, with silver expected to surge towards $60 to $70 before any meaningful pullback. Unlike past rallies, this move is supported by deeper global and macroeconomic shifts. The dollar index has been flat for nearly a decade, yet gold has more than tripled, showing that other forces are driving demand. Weakness in treasury bonds, signs of a topping stock market, and risks of a sharp Bitcoin decline could all funnel more money into precious metals. With these pressures building, gold and silver may see explosive upside before year-end, as investors rush to safe havens amid mounting financial instability. Before we begin, please subscribe and enable the notification bell so you stay up to date. We'd love to hear your thoughts, so please share them in the comments.
Well, gold's momentum is positive. In the 5 months of horizontal price action we've seen, it allowed all the doubters, and there are ever doubters out there. It's got to correct, it's got to go back to 20, this level or that level, some old high, and it didn't do it. They sold into it repeatedly, like 3 times. It got up to 3,500 or 3,450. Right now, we did trade above 3,500 today, by the way, using October gold. They couldn't break it. They sold it, and they kept getting these $100 and $150 pullbacks, and then bang, you're back up again. So I guess they got taught a lesson that this is not some beast that has to correct big time. Instead, it had a correction by standing still for 5 months. And our work on momentum and clockwork of momentum, meaning often momentum swings can be measured on certain of our metrics in terms of how many months have been spent trending up on the oscillator or down on the oscillator. And for that 5 months, we've had a corrective downside process in momentum as it cooled off while price went lateral. The clock is old. We said that about several weeks ago, and sure enough, bang, we're up through the highs again. I think the game is started again. I'm not quite sure where gold's going to go in this particular surge. Ultimately, it may go to 10, 20,000, okay? But we're focused right now on MSA on this issue. This particular surge will not end the bull market, but it will be dramatic. And therefore, if you're invested in the monetary metals, particularly the silver side and the gold miners, which are now also outperforming gold, we're looking for points to take profits. But I'm going to tell you that in the case of silver, we're not looking for it, frankly, until we get to 60 to 70. Because we've blown out the idiot highs, which means, pardon me, those who missed the move had ignored it and doubted it, will suddenly say, well, golly, I got to be in that, okay? And then you get a further gush of money into a fairly small market, which could easily goose it into that zone, and we've got some reasons for that zone. But ultimately, there could be a correction up there, not the top. So if you're fully invested, unleveraged, ignore what I'm saying. Because I think we've been arguing that this move in gold and silver is different from the prior ones. This time, I think there's more fundamental and macro-technical events going on globally and in major asset categories, not just a stock market top, which I think has been making since early this year. It's a widening top, but it's a topping pattern. But in certain other areas like the breaking of the dollar, dollar has not been a factor, the dollar index, when you measure it versus euro and yen primarily, that's 70% of the dollar index. It's been sideways since 2015 when gold made its low. It's trading around 98 right now. We're trading just below 98. So, yeah, it's been above it and below it since then. But 10 years, it's been net lateral. Well, why is gold not net lateral? It's triple and a half. So you don't just look at the dollar for driving gold, but it will help because it's now entered what could be a dynamic bear market. And dynamic on the downside could, in fact, be further wind for gold. Then we go to the T-bonds. T-bonds are usually an alternative. If you have a perception of a weakening stock market, people will tend to move money into T-bonds as the alternative. They're not. T-bonds are very anemic. They're very weak. They're behaving more like the stock market in terms of when they make lows and highs. And right now, T-bonds, as we speak, are not far away from some levels that if they break below, you could end up getting a little mini bond market event, which would spook the stock market. Anyway, there's a lot of these factors out there, including Bitcoin, I think, which is in a potential crash situation. We've been saying that for a few months. Not that we're there. The trigger numbers are still below us, but if you hit those trigger numbers, that could suddenly become an off-the-sideline type, oh my God, where did that happen? How did that occur? And it will have wave effects because of financial institutions that are now so heavily involved in crypto. So anyway, these events are out there percolating, and I think they're going to occur. And when they do, that could create further upside panic in the monetary metals. And I think we're going to see that between now and the end of the year, possibly sooner than that.
Michael thinks that gold's rise since 2015 can't be explained by the usual drivers like a weak dollar, falling stocks, higher commodities, or bond shifts. Instead, it reflects something bigger, deep distortions created by government control of money. These forces are converging, setting up a cascade that could spark central bank panic. Silver is expected to break past its old $50 high and surge towards $60 to $70, drawing in late investors before any correction. Still, that would only be a pause, not the end of the bull run. Historically, gold has delivered two eightfold moves in the past 50 years, and repeating that pattern today would put it near $8,000. Analysts argue this wouldn't even be unusual. It would simply mirror past cycles. Michael predicts that if gold does reach those levels, silver could climb dramatically as well, possibly reaching 2% of gold's price. Commodities may follow along, but the real fireworks are expected in gold, silver, and mining stocks, making the coming surge both dramatic and highly concentrated in monetary metals. Now let's revisit the interview.
Explain, we showed in the weekend report the chart of gold since 2015, and there's this upward plotting action and then it's accelerating. And you say, well, what caused that? And it wasn't because it was declining stock market, which helps gold. If you go back 2000, 2002, 2007 high in the stock market to 2009, gold went net up. There was one break in there, but it kept going up. But we don't have that right now. So it's not the weakening stock market yet. It's helping gold, so we will, because money will move. It's not reflected by the bond market. It's not reflected in commodities. The Bloomberg pullback from a high at 140 to either side of 100 back in 2022, dropped in 23, and then went sideways, has been dull for a couple of years. So it isn't commodity prices, so-called commodity inflation. You look around, and it's not the dollar. The dollar has been Deadsville. It's recently started to drop, but it's not precipitous yet. So how can you explain this? Well, because there's something bigger going on. It's not merely one of these things. It's a combination of things, largely built around the distortions created by government monopoly over money. And gold knows this. And later on, you'll see the headlines, and you'll look back and say, oh, now I know why. But don't look for the reasons why to be in your face as it's doing it. Look for them later. Too late to be joining. Okay, not too late, but you're late. Okay, already you're late if you're not in. So that's why I think things will change more dramatically this time, is that all these factors, not just one of them, all of a sudden now we have a lot of factors that are at the point of cascade, which would create what? Total panic on the part of central banks. Well, for silver, I think we'll take out the 50 high, and I think you'd at least go to 60, 70. And at that point forward, once we cleared that high and sucked in a lot of late money, grabbing it, wet bar soap stuff, there'll be a point to take some profits on a trading basis. Not that the move is over, okay. But if you historically, and I've said this over and over, and I'm not predicting the price because I think it'd go way beyond it, gold has had a couple eightfold moves. 1976 low to the 1980 high, eightfold gain. 2001 lows, 2011 highs, eightfold gain. Well, we started from a low at 1,050. You want to do the math? Somewhere between $8,000 and $9,000, you would simply be reflecting what it's already done twice in the last 50 years since the U.S. government legalized it. Okay? So to go to $8,000 now and gold would simply say, oh, it's doing what it did before, which isn't even abnormal. But what we're talking about is something far more abnormal. And therefore, you could go way beyond that on a fundamental or technical basis. But right now, even just echoing what it's done twice before, the same dimension move, you go to $8,000 gold, wouldn't shock me one bit, particularly when these other factors start to come into play, which I think could be in the next month or so. Anyway, so that would give you an idea. Well, gold maybe go to 8,000. Well, that's just, again, it's just doing what it did before. Is that a top? No, probably not. But it's a statement of, goodness knows where silver might be then. You want to put silver at 2% of 8,000, okay? Anyway, that's what I think we're shaping up for. And I think it's going to be dramatic. And it's going to be very isolated, very focused in monetary metals and their miners. I think to some extent commodities will coattail, not lead, not cause, but coattail gold in this up move, much like they did in the late 70s. Where commodities coattailed the bull market to the 1980 peak in gold. They didn't match it in terms of upside, but they did coattail it. And I think we could see that again. But I think it's not outlandish to think of $8,000 gold. Now, again, what does that mean? Well, a little more than doubling where you are now. Is that a big deal? I don't know.
Michael Oliver highlights that both gold and silver are entering a powerful new phase, driven not by traditional market factors but by deeper systemic distortions in the global monetary system. With gold potentially targeting $8,000 to $20,000 and silver set to surge past its old highs towards $60 to $70 or more, the precious metals market may soon witness one of the most dramatic bull runs in history. This rally, fueled by weakening confidence in traditional assets and central bank actions, suggests that silver and gold miners could offer some of the strongest opportunities in the coming years. If gold were to reach $8,000 or higher, how high could silver realistically climb relative to gold's value? Do you think central banks will intervene directly in the silver and gold markets if the rally becomes too explosive? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.
Both when you measure silver relative to gold in the bull markets, like 1979, 80, or 2010, 11, silver versus gold was up in the 3.5% to 6% range price of gold. Well, that would mean relative tripling to get to the old bull highs on the spread. Let's say the 3+%. So, we're at right now well above 1%, but you get up to 3%. That would mean, well, I throw this number out a lot, and it's not a projection. I think you'll go way past it. But gold has had two bull markets in the last 50 years where it's gone up ninefold. Okay, if you go up ninefold this time, it means you're going to $8,500 gold because our low is $1,050. Right. So a ninefold move from 2015 to, that's just replicating what you've done twice before. The circumstances this time are far more monstrous in terms of driving it much higher. The monetary crisis we'll face, the government debt crisis. So stopping at 8,000 is highly unlikely, but even if you went to 8,000, do a tripling of silver relative gold, silver would be at $240.
In past bull markets, silver traded at 3 to 6% of gold's price versus just over 1% today, highlighting major upside if it reverts to historical norms. While gold reaching $8,500 is only a bullish scenario, at a 3% ratio, silver could be around $240. With rising industrial demand, persistent supply deficits, and mounting global debt pressures, silver is viewed as deeply undervalued, reinforced by the elevated gold-to-silver ratio above 90 to 1 compared to its long-term 40 to 70 average. Michael Oliver, veteran market analyst and the founder of Momentum Structural Analysis, highlights that silver is experiencing its largest demand surge in decades, especially in solar, electronics, AI, and defense sectors. Meanwhile, supply is shrinking due to declining mine output and inadequate recycling. MarketWatch describes this as a potential supercycle, with severe supply deficits encouraging a powerful, bullish run. Noting this, Michael Oliver predicts that silver is entering an acceleration phase and could reach $60 to $70 by year-end, surpassing its old highs near $50 from 1980 and 2011. Adjusted for money supply growth and inflation, silver would need to be around $200 today to equal those past highs in real terms. They believe this surge will break well beyond those outdated levels. Silver has broken through long-term resistance at $34.90, surging to $38 to $39, its highest in 13 years, signaling an incredible breakout, with technical targets of $41 to $42 and potential for a larger structural rally. While silver has jumped approximately 54% from $24 this year, mining stocks remain undervalued, attracting institutional and ETF inflows. With industrial demand from solar, electronics, AI, and defense rising against tightening supply and reported deficits, the outlook remains strongly bullish. In order to receive fast notifications whenever we release a new video, please like this video, subscribe to our channel, and turn on the notification bell.
Yeah, they've already done that, frankly. Silver had a high back in October of last year at 35. It dropped. Came back up in March of this year, hit 35 again, dropped. In fact, it had a cleansing drop down to 27.50. And then came back up, and in June, it got up above 34 again. Again, not taking out the 35 plus highs. Okay, they were like 35.50 each. But at 34.90 area, we had a major momentum breakout of a structure that said, okay, silver's coming out of this congestion. By congestion, I mean, if you go back to May of last year, silver was 32.70 at a high. You could draw a line sideways through May of this year where it was either side of that level, up and down, but really just net sideways. When it got back to 34.90 in late June, we said, that's it, it's coming out of here. Whoosh, went up to 39. Now, you know, as typical, the price chart guys like to sell round numbers or just in front of them. So let's risk 40, okay? Okay, now we're trading either side of 39 right now on the September contract. We think the process has already begun that you were asking about. We think the acceleration phase in silver and the miners. Now, for instance, GDX has gone from a sleepy upside pattern to suddenly it's now up to near its 2011 highs. We expect GDX not to even stop until it clears its 2011 highs, meaning get up in the upper 60s. And same with the miners in general. Silver, we think in this move, in this acceleration phase for it and it relative to gold, is likely by the end of the year to see $60 to $70, meaning those old antique highs at 50 in 1980 and 2011, which are really sort of jokes. Because one, you were up there very briefly, like days, and back down. And when you do a real valuation, the degradation of the money unit since 1980, the increase in the M2, or since 2011 even, heck, gold would probably have to, silver would have to be $200 now to just match in real value terms those price highs we saw then. So it's catching up. And I think this surge will blow past those, what we call idiot highs. And at that point, what's going to happen? The public's going to say, oh my gosh, I missed this. I got to be in it. And so I think that's when you're going to see an onrush, fairly fresh, of money moving out of the doubting stock market into, hey, I missed this. I got to be in it. The gold, silver miners, and silver. And that's when you get this gush effect, the wet bar soap effect, you know, where everybody's grabbing it, it goes up. And this is not unusual in markets anyway, but especially in these situations, I think I think we're in process right now, in other words.
So when we consider that type of move, Michael, do you see this as more of a different type of new high? As you said, this was kind of a silly joke of a high, you know, up to $50 and instantly back
Yeah.
down. Do you see this as a possibility of being a more sustained type
Yes.
of new price level for these metals?
Yeah, and
Or
both
for
when you
silver?
measure silver relative to gold in the bull markets, like 1979, 80, or 2010, 11, silver versus gold was up in the 3.5% to 6% range price of gold.
Mhm.
Well, that would mean relative tripling to get to the old bull highs on the spread. Let's say the 3+%. So, we're not right now well above 1%, but you get up to 3%. That would mean, well, I throw this number out a lot, and it's not a projection. I think you'll go way past it. But gold has had two bull markets in the last 50 years where it's gone up ninefold. Okay. If you go up ninefold this time, it means you're going to $8,500 gold because our low is 1,050.
Right.
So a ninefold move from 2015 to, that's just replicating what you've done twice before. The circumstances this time are far more monstrous in terms of driving it much higher. The monetary crisis we'll face, the government debt crisis. So stopping at 8,000 is highly unlikely. But even if you went to 8,000, do a tripling of silver relatively. Silver would be at $240. Is that about right? So it's the point being, when we go up there this time, also the events in the world, and in the street events, the academic notions about what works, what doesn't.
Michael also compares silver with gold in a way that he points out that silver has a history of outperforming gold during strong rallies, like in 2020, when silver nearly doubled while gold rose only about 25 to 30%. Recently, the silver-to-gold ratio fell below 1%, meaning silver was priced at just 1% of gold's value, a rare level that historically signals a strong buying opportunity. Over the past few months, silver has started to outperform again, while gold has mostly moved sideways, showing strength that suggests it's entering a new phase of outperformance. Looking at long-term trends, silver often reaches around 2% of gold's price, so doubling in relative value, while gold itself looks ready to resume its upward move soon. The best opportunities right now appear to be in silver and mining stocks, with gold likely to follow later.
That's the growth. Also, state and local government was a huge component the last time around. And usually government hiring has been a huge thing for the last 6 months. And when you look at things like transportation or factory, flat to dead, if not declining. But the overall number looks great. Okay. So it's all illusory stuff. And he finally admitted to it. That's great. So anyway.
So, Michael, we've talked a lot about gold and its reaction here. Do you think we should be thinking any differently about silver's reaction, despite the setup for gold with the interest rates and the equity markets that we've already touched on?
I think silver is participating with gold. It vastly outpaced gold in that 2020 rally. Silver almost doubled in price, whereas gold went up about $500, which is like 25%, 30% rally. Silver doubled. So into mid-2020, silver had outperformed gold on a percentage basis. But from 2020 through, the recent low, the silver spread went from like 1.5% of the price of gold down to 1% of the price of gold, even got below 1%. We divide an ounce into ounce and you find it was 1% of the price of gold. If you go back through 50 years of history and look at that spread relationship, you'll see that when you get down to the 1% level, it's time to buy silver. Okay. It's meaning it's dirt cheap. It's not going to go to zero versus gold. Okay. But then the technicals turned. And so over the last 4 or 5 months, you've seen silver outperform gold. Like, for example, back in April, gold hit 3,500. It's gone sideways. April, May, June, July, now, August. 4.5 months of comatose but steady sideways. They keep trying to sell it, but then go down. But it also doesn't go up. So it's had a sideways correction, which is, by the way, not the way gold ever tops. Okay. During that time, silver's gone up sharply. Okay. We assess technically that silver is now at a point where it's going to outperform gold fairly dramatically. If you go back over 50 years and look at that same spread, you'll see the number of years it got up to at least 2% of the price of gold was like 21 of those 50 years. So it's not abnormal at all. So from the recent low of 1% to 2%, meaning silver could double in relative value to gold. Oh, probably over the next year. Wouldn't be surprising me by the end of the year even. Same is true with the gold and silver miners. They're back into outperform mode versus gold. And if you'll look at gold sideways since April, look what GDX has done. Vertical. Okay. So I think those parts of the monetary complex are the place to be right now. Silver, the gold and silver miners. Gold will re-engage, and I think it's going to re-engage probably later this month or next to the upside, where people say, oh, it's awake again. Mm-hmm. But silver and the miners will be the place to be.
Silver appears to be entering a powerful new bull phase, supported by historic undervaluation relative to gold, record industrial demand, tightening supply, and strong technical momentum. With prices breaking out to multi-year highs and miners still undervalued, analysts like Michael Oliver see silver leading the precious metals complex, potentially reaching levels far beyond its old peaks. This makes silver and mining stocks some of the most compelling opportunities in today's markets. If silver truly enters a super cycle, how high could prices realistically go beyond the $60 to $70 near-term targets? With mining stocks still undervalued, should investors focus more on physical silver or silver equities to capture the upside? Please leave a remark in the section below with your ideas. Please remember to subscribe to receive updates, and if you find this helpful content, kindly give it a thumbs up. We are grateful that you joined us on this journey.